Earnings season has become front and center, and earnings have been strong.
People are investing more seriously than ever before, at least in the U.S.
This market has continued to rally and probably draws more and more people off the sidelines.
This is a very good economy for equities.
The underlying thesis on consumers and business spend is positive.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, hoping for a breakthrough.
We're going to have a great talk. I have a lot of respect for President Xi. I like him a lot. He likes me a lot. I think we're going to have a successful transaction.
The US talking up progress ahead of this week's Trump-Xi meeting as Chair Powell's Federal Reserve prepares for the next big decision. The busiest week of earnings season is upon us. Big tech results up next. A massive week just around the corner.
$27 trillion of market cap reporting this week. Just the big tech stocks that are reporting, which include Microsoft, Alphabet, Meta, Apple, and Amazon, account for a quarter of the total market capitalization of the S&P 500. To me, this is the big event. Can they surpass expectations? Do their shares rally in response to that beat? And then what does this mean about their investment thesis going forward, given that their capital expenditure programs have really driven GDP so far this year?
That's the story for Wednesday and Thursday. Let's talk about the other two stories that look largely baked. A Federal Reserve rate cut on Wednesday and maybe a comprehensive deal between the US and China. Based on a commentary over the weekend, things are looking good.
Things are looking good, but we really need to recalibrate where we are today. We're basically back to where both sides were at the Geneva talks in May. 100% tariffs that the president has threatened taken off the table. You have the fact that China is talking about, or at least the Treasury Secretary and Jamieson Greer, ambassador of USTR, are both talking about the fact that the rare earth export issue is going to be solved or at least deferred for another year. So we were going into this meeting with potentially a ton of leverage. Both of these sides were trying to bake into the market, and guess what? They all brought it back.
Equity futures up by 0.9% on the S&P 500. A record high close on Friday. We're looking for more record highs later on this morning. Coming up this hour, Alistair Pinder of HSBC, with stocks facing a make-or-break week of earnings. Elizabeth Economy of the Hoover Institution as the US and China line up a trade deal. And Veronica Clark of Citi looking ahead to the Fed rate decision. We begin this hour with stocks rising on signs the US and China are closing in on a trade deal. Alistair Pinder of HSBC writing, global equities can continue to grind higher from here. We don't think we are in bubble territory just yet. Alistair joins us now for more. Alistair, good morning. It's good to see you.
Thank you. Thanks for having me.
So 3 big events: trade talks, Fed decision, earnings.
Yeah.
What's the most important one for you this morning?
That's a great question. I would say earnings. I think people, I've done a lot of marketing. I was in Asia the last couple of weeks. The number one question from clients is, are we in an AI bubble? I'm in every single meeting. So maybe that convinces me that we're not in an AI bubble, but I think that's going to be the key catalyst this week. I mean, the earnings season so far has been amazing, right? 87% of beats. We're running at 10% growth year on year. I think if the Mag 7 can continue to deliver, that continues to drive a lot of upside. I think the next biggest one for me will be the China trade deal. I think if we just get any kind of agreement, it just starts to ease more and more trade uncertainty, and we can start looking more aggressively into the upside risks into 2026.
Well, let's start with earnings. So massive week, Wednesday, Thursday. There's been a ton of spending. There's going to be even more through next year as well. Are we testing the limits of investor tolerance around all that capex?
I think we are. I mean, we're definitely, people are asking a lot of questions. I think the question now is, though, can you monetize that? That is the number one question. And I think this is where you're going to be looking deeply into the earnings call at this point and being like, to what extent is Microsoft and these other, big enablers able to generate profit from all of this capex growth at this perspective? I would say, the Mag 7 have historically done a phenomenal job of proving that they can generate huge return on investment. But I think, again, the key question for me that I've been having is, what are some of the AI hedges? What are some of the ways that we can basically mitigate some of the risks if they can't generate the profits on these capex?
I want to understand what we're pricing in, because it's one thing to say, look, they've been generating a ton of cash and they're expected to beat by something like 15% this particular quarter. That is the lowest beat, though, in terms of these companies going back to the beginning of 2023. How much of the spend that we know about is already baked in? How much do you need to see some sort of extraordinary profiting from some of the investment to really get excited?
Well, I think if you look at the valuations here, I mean, the valuations for the Mag 7 are basically in line line with their median over the last 10 years. So again, it kind of indicates to me that we're not necessarily pricing in the most bullish of scenarios for the Mag 7 here. And I think there's certain areas of the market which are massively underpricing some of the AI upside. I think one of the biggest narratives for the market going into 2026 will be around the AI adopters, those companies that are using AI, saving costs, becoming more productive, and increasing their margins going into next year. I just don't think that's priced at all. And we're seeing a lot of evidence from the earnings season this quarter and last quarter that companies are actually generating upside from
the broadening out trade.
Exactly.
That's sort of where you're seeing this going to be potentially as playing out. The other point that you're making is you think that the China-U.S. talks are really going to be a significant driver and a potential upside. Everyone's been saying that, but has the downside ever been priced into stocks? I mean, has anyone actually considered a true break in this relationship?
I mean, I don't think the true break in this relationship has been properly priced. I mean, if we don't get a trade deal this week, I think that is going to be a big scare for the market. I think the market is pricing this in terms of a game theory kind of aspect here, which is that the downside risks for both parties is just too big if they don't come to a trade deal. But I think, we saw with China just a couple of weeks ago with the rare earth materials and some of the comments there, how much that can unnerve markets. The S&P 500 down a couple of % on that. I think if we just move past all of this uncertainty, that will give another leg higher. And again, you see that in the futures today of just how much the market is reacting to this positively.
But this isn't actually a deal. It's really a delay because the rare earth issue is going to be deferred until next year. How much is this just kicking all these nerves and concerns about China down the road?
I mean, I guess it is. I mean, again, this is where the details are really going to matter, right? Where I think if there's some element of a framework, I mean, this is what they keep on saying. It's a framework from what, soybeans, the rare earth materials, TikTok, all of these different things. If that framework seems firmly in place, I think, the markets will kind of look past that and start to price that in aggressively, even if the details, specifically on the agreement aren't particularly fleshed out.
China calls it a preliminary consensus. Doesn't that feel like China's going into this with less enthusiasm than the United States? A preliminary consensus?
I mean, I think it shows you that China is, feels like they have leverage and that they want to try and get a good deal for them. I think a good deal for everyone is something which is definitely an option, and it feels like that's on the cards. And, if we start to price out this trade risk, which has just been bugging us all year, we really start to price that out and we start focusing on to 2026, where a lot of positive narratives are coming through. Fed easing, a potential increase in growth. Also, China, specifically with their 5-year plan, what are they going to do when they start fleshing out details there? I think that, again, is just more and more catalyst for upside for global equities going into next year.
So what are we taking for granted? And you used the phrase there, Fed easing. And I just wonder to what extent the Fed can guide beyond this meeting this coming Wednesday.
Well, this meeting is extremely difficult, right? With all the lack of data they have, I mean, they're in almost an impossible position. I think the market is pricing in a lot when it comes to Fed easing next year. I think the biggest downside risk for me is, what if the Fed can't ease as aggressively because inflation is sticky, because maybe growth is too strong, and that actually causes the bond yields to start backing up a little bit, and that causes valuations to contract. That, for me, is the biggest risk, but I don't see that materializing in the market until probably Q1 or Q2 of next year.
I see this across the board on Wall Street coming into this week from Bank of America that Powell can't give much forward guidance for December. Deutsche Bank saying essentially the same thing. Chair Powell is unlikely to provide clear signals about the policy path ahead. Do you think there's some scope for disappointment this Wednesday afternoon?
I don't think there's scope for disappointment. I think it just basically means that things are going to be left unchanged. I completely agree with that narrative, which is that if you don't have, much scope to provide a lot of guidance, why shift your view dramatically here? Why not wait until you get more clarity on the data front? I think one of the interesting things, when it comes to the US is that there's still $10 trillion of cash or money sitting in cash. $4 trillion in time deposits. That's really held by the retail investor, which is very sensitive to changes in interest rates. So if the Fed cuts again and then they cut again in December, I still think there's a lot of money here which can go out of cash and move into equities.
This is the whole idea that people have been expecting, right? The cash on the sidelines. What will it take? Some cuts from the Federal Reserve. Where does that cash go? How much do you think stays in the U.S.? How much do you think goes elsewhere?
I mean, if you're a U.S. investor, I think you see the S&P 500, you're going to feel... I think it can feel difficult to feel compelled to put that money in international equity markets. I think it's going to stay home, to be honest with you. And then the question is, well, at home, where do you put it? Do you start putting it into higher yielding, fixed income? Well, spreads are near record, lows. So why not just put it into equities at this point? And that's the market which I think is driving, the biggest returns at this point. So I still feel like there's this allocation of cash going into equities here.
Okay, which is interesting given the duration trade that some people say will benefit significantly. I'm trying to square from your notes, you were talking about how you are really bullish on emerging markets.
Totally.
And right now, you're making a huge argument for the United States, which is the epicenter of tech. How do you square that?
Because I'm super bullish on emerging markets. That's why. So, I mean, two things that I think are really compelling for EM at this point. One is the dollar, right? The dollar's going to weaken. That naturally is a big upside for EM. And the thing which I also think just goes really sort of isn't really touched on enough when it comes to EM is that EM is a growth market, right? EM has 40% of its stocks are in essentially techie areas. And guess what those tech sectors, aren't doing? Tons of capex like the Mag 7. So if you are a global investor and you're scared about the Mag 7 and the capex story, why not just reallocate a little bit to EM Asia Tech here? And we're starting to see that from global funds. And so I think that's one of the reasons why I think, Asia and Asia Tech and EM as a whole can do very well next year.
Two very different approaches. Asia versus the US when it comes to tech. Alistair, I appreciate your time. It's good to see you. Thank you, sir. Alistair Pinder there of HSBC. Equities doing better today worldwide. With that, bond yields are a little bit higher across the curve. 10-year bond yields up by 2 basis points. We will get some supply this week. Later on this afternoon, $70 billion of 5-year notes. Tomorrow, $30 billion, or rather $44 billion of 7-year notes, and a potential for a lot of corporate debt issuance this week as well. Yeah, keep an eye on that too.
We might get that $38 billion of Oracle bonds that people were talking about last week. How much does this affect anything, or is the demand so insatiable that it overwhelms any supply? It's a really good question. I mean, this is a lot of supply this year, this year. It's like a week. $69 billion of 2-year notes, as you mentioned, $70 billion of 5-year notes, and $44 billion of 2-year notes in 2 days ahead of a lot of these big tech earnings.
10-year bond yields this morning higher by 2 basis points, 4.02% on a 10-year maturity. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahira for more. Hey, Yahira.
Good morning, John. President Javier Milei's party won Argentina's midterm vote. Milei said he'd have the backing of 101 members of the lower house and 20 senators, protecting his veto power. The result allows him to pursue free market policies with billions of dollars in backing from the Trump administration. Meanwhile, the U.S. and China are closing in on a trade deal. Both sides spent the weekend in Malaysia coming to terms on a range of issues, including export controls, fentanyl, and shipping fees. Treasury Secretary Scott Bessent says President Trump's threat of a 100% tariff on Chinese goods is effectively off the table, and he expects China will make substantial purchases of American soybeans. Secretary Bessent also announcing he's narrowed down the list of candidates to succeed Fed Chair Jay Powell to 5. Speaking to reporters aboard Air Force One, Bessent said the candidate pool is made up of Christopher Waller, Kevin Warsh, Kevin Hassett, Michelle Bowman, and Rick Reeder. President Donald Trump says he expects to make a decision before the end of the year. That's your Bloomberg brief. John.
Yahira, thank you. Thank you very much. More from Yahira in about 30 minutes' time. Up next on the programme, teeing up a trade deal.
We're going to have a great talk. I have a lot of respect for President Xi. I like him a lot. He likes me a lot. I think we're going to have a successful transaction.
That conversation up next with Elizabeth Economy of the Hoover Institution. Live from New York City this morning. Good morning. What a week coming up, full of earnings. Check it out. Wednesday, Microsoft, Alphabet, Meta. Thursday, Apple, Amazon. The biggest week of earnings season is just around the corner. In the equity market on the S&P 500, positive by 0.9%. 2-day winning streak into Monday. 2-week winning streak coming into this week. On the Nasdaq 100 this morning, the melt-up begins early, up by 1.3% on the Nasdaq 100. And the surveillance this morning, teeing up a trade deal.
What we understood yesterday or 2 days ago or even today is not going to be necessarily what it's going to be in 2 days. I mean, we're going to have a great talk. I have a lot of respect for President Xi. I like him a lot. He likes me a lot, I believe, and respects me, and I think he respects our country a lot. And I think we're going to have a successful transaction for both countries.
So here's the latest this morning. President Trump hailing progress in recent trade talks with China over several key issues ahead of his big meeting with President Xi on Thursday. Bloomberg's Tyler Kendall joins us now from Tokyo for more. Tyler, welcome to the show and good evening to you, Tyler. The tone already pretty good coming into Monday.
Yeah, hey, John. Good evening where I am. Good morning to you. And we have seen some encouraging signs from really both sides in what feels like a marked contrast compared to the escalation of recent weeks. Most notably, the U.S. Treasury Secretary Scott Bessent saying that he and his trade counterparts have essentially teed up this framework for President Trump and Chinese President Xi Jinping to finalize when they meet face-to-face later this week. The general understanding here is that this is likely going to result in an extension to the trade truce that is currently in place and set to expire on November 10th, though we are gleaning some additional details on what it could entail. The Treasury Secretary going on to suggest that Beijing is going to delay and review its recently unveiled export curbs related to critical and rare earth minerals that are set to be enforced on December 1st, and also that China is going to resume its purchases of U.S. soybeans, though at this point there are still some big questions here about how much and how quickly American farmers will see relief. Now, according to U.S. officials, the U.S. isn't going to loosen any of its curbs related to advanced semiconductor chips. But I will say that our own analysts at Bloomberg Economics say that they do expect the U.S. to take off the table those threatened but not yet imposed curbs related to the supply chain, including on critical software and cloud computing that we've seen floated in recent weeks. Now, importantly, I'm watching really closely what's going to happen to that 20% tariff tied to fentanyl concerns, as both sides say they've made progress on the issue. And then in terms of what China is looking for, we've heard from Chinese officials that the U.S. is going to no longer impose fees on Chinese ships that are docked at American ports. John, there is a lot to look out for here, but one thing that's emerging is that it appears that the White House is trying to use the stops ahead of Thursday's meeting to gain additional leverage. Just look at the critical mineral deal signed with some Southeast Asian countries over the weekend, all in an attempt to loosen China's grip on the global market.
Tyler with the latest. Tyler Kendall over in Tokyo, Japan. Tyler, thank you very much. The market's treating this as if it's just inevitable now. Equity markets are higher by 0.9%. Equities are up globally. Is there anything inevitable about this coming Thursday?
Well, this is the bar. They have to at least meet this or exceed it on Thursday, or the market is going to come back with a vengeance. But I think this was always going to be the base case. We're pretty much going back to what they agreed upon months ago. All the threats of the prior 2-3 weeks just being taken off the table. The real issue is, can the United States do enough of these mineral deals in time for when China starts to re-examine the rare earth export controls in a year's time?
Joining us now to discuss is Elizabeth Economy of the Hoover Institution and the former White House senior advisor for China under President Biden. Elizabeth, welcome back to the program. I'm going to ask the following question. Forgive the snark, but if we're still talking about soybeans, how much progress are we actually making?
Right. I mean, I think it's a fair question. Look, this is great news, and I think it does amount to a trade reset. But it's absolutely fair to note that, really, with the exception of the TikTok deal, that all of this just brings us back out of the hole that we ourselves have dug over the past 9 to 10 months since the administration came into office. So there's no real trade advance here. There are no new deals being struck, except for the fact that, yes, we're hoping to get soybean purchases back to where they were in 2024, because they've essentially fallen off to zero over the past few months. So I think, let's be happy that we're getting some stability back in this relationship, but let's also just acknowledge that we created a huge problem, and now we're basically just solving that problem.
Well, Elizabeth, did the United States create the problem, or China with their unfair trade practices and also really ratcheting up the rhetoric when it comes to the rare earth export controls?
Well, the rare earth export control issue, really didn't begin in any way that we've seen right now until we started this whole trade war. Sure, there were some restrictions on critical minerals that were put in place during the Biden administration and then again early in the Trump administration, but that's vastly different from the move that they just made. And I think they have an interest at this point in taking a step back from that as well, because that wasn't just targeted against the United States. That was a global, sort of new licensing and export control regime on rare earths that they were putting in place. And I think they did not expect the backlash that they faced. And I think also just it's a very difficult thing for them to enforce. So they want some more time to figure out, is there more nuance in how they would do it? What would this actually look like? And so I think for them, they're taking this step back is actually a good move.
China's threat on the rare earth export controls saw the Europeans really up in arms, even as far as they said they're willing to use the anti-coercion tool. Did China bring Europe and the United States together in this sense?
Yeah, I think one of the disappointing things for China, frankly speaking, with the advent of the Trump administration, I think China believed that they had a huge opportunity to draw closer to Europe, and that just hasn't materialized. And it hasn't materialized in part because of China's, economic support for Russia in terms of its, war against Ukraine, and because of China's export of its overcapacity. These are two pretty existential issues for Europe, and this just added a third issue. Sort of this big regime on export controls, big export control regime on rare earths. And so I think all of those things really kept the United States and Europe more, close together than probably one would have anticipated given the nature of the Trump administration and its overall relations with Europe.
It seems like there are moving targets. And right now, the ultimate one is really the rare earths issue, the soybeans issue, and the big tech issue, the question of technology exports to China. Those seem like the main issues that are resolved in clear priorities for both sides. Do we have a sense of what else is on the table, what else is being discussed, and where there might be some overlap or agreement on some of those issues? I'm thinking of Taiwan. I'm thinking of different national security efforts. I'm talking about source of origin when it comes to evaluation of goods when it's imported to the United States.
Yeah, I mean, I think, President Trump has mentioned his desire to have a larger deal, a peace deal that that we're going to work out with China. Frankly, my hope is that that's going to be focused on Russia, Ukraine. One could also imagine maybe we would tackle an incredibly, important issue around Myanmar. I think on Taiwan, which, has been there's been a lot of discussion about that here in the United States, whether the president is interested in somehow folding Taiwan into some deal, which we know the Chinese would like, right? They would like to see us take a step back, for example, from our export of arms to Taiwan. Secretary of State Marco Rubio just said that Taiwan is off the table, that Taiwan is not going to be part of any larger deal between the United States and China, at least for now. So I think, that's hopefully we can put that to the side because I don't think we want to be negotiating away Taiwan's, sort of the degree of sovereignty that Taiwan has today. I think there are other issues. You mentioned, we still have tariffs on China that are quite significant, 55%, that those don't seem to be overall being rolled back. I think that your reporter mentioned that the sort of 20% extra tariff on fentanyl. If there's progress on getting the Chinese to do more there, I think that would be great. We haven't heard anything about the investigations that are underway into a number of American tech companies, NVIDIA, Qualcomm. There's Micron, rumors of an investigation against Intel. These are all things that I think the United States should be pushing China on because these investigations are also just about basically closing out our semiconductor firms, from exporting to China. So I think there are a lot of other issues, overcapacity from China. We're not dealing with the big structural issues in the Chinese economy, going back to the point that was made about unfair Chinese trade practices. We're not dealing with those. Those have not been on the table yet. Those are complex negotiations. And maybe after we, again, dig ourselves out of this hole, we could begin to move forward on a bigger, real trade deal that would get the Chinese to do some changes to their, fundamental economic model.
Liz, appreciate it as always. One of the best. Elizabeth Economy there of the Hoover Institution. The commitment to overcapacity in China is going to continue to stir up emotions in both the United States and in Europe.
Yeah, how much is China aware of the international relations aspect of this? How much do they really want to not press their luck too much when it comes to both Southeast Asia, but also with Europe, right? How much are they trying to keep people close, keep your enemies closer than your friends? There is a feeling that part of why they're coming to the table is because of the outrage about rare earths globally.
Strategic misstep. They made a bit of a mistake in the past few weeks, I think, and you can see them trying to walk that back.
But at the same time, that mistake meant the United States was really ready to make a deal and almost running to the table because of what is going on with rare earths.
Futures this morning positive by 0.9% on the S&P. We still have a government shutdown. Week 4. Terry Haynes of Pangea Policy up next. More than $10 trillion of earnings on Wednesday, more than $10 trillion of market cap reporting again on Thursday. All of that still to come, and we rally into it and rally hard, up by 1.3% on the Nasdaq 100, up by 0.9 on the S&P 500, as it looks like we have a very constructive tone heading into this meeting between Trump and Xi this coming Thursday. In the bond market, 2-year, 10-year, 30-year bond yields this morning just a little bit higher. Yields up by 2 basis points. On a 10-year maturity, 4.02%. We have gone 4 weeks without rising yields following a softer inflation print just last week, helping to keep a lid on things this week. Just a bit of a supply test just around the corner.
Given the fact that we've got treasuries being sold 2-year, 5-year, and 7-year denominations and that $38 billion Oracle sale, a real question whether the appetite continues, given that yields are fairly low relative to expectations coming into this, given the fact that now we don't care about inflation prints. We really just care about the employment picture, which, by the way, we're not getting.
Market's so comfortable with 3. It's kind of crazy how comfortable everyone seems to be with 3% CPI.
You know, I don't understand exactly why. Is it because they see the disinflationary force from artificial intelligence? Is it because of rent? Is it because of something else? Because if you look at a lot of the current issues in terms of goods, prices are going up at a faster pace, not a slower one.
Chairman Powell will have to wrestle with the communication around that story this coming Wednesday afternoon. As we count you down to the opening bell about 3 hours away. With your morning movers, let's cross over to Danny for more. Hey, Danny.
Good morning, John. Starting with some deal news this Monday, Novartis will be buying Avidity. It is an American biotech company. For Novartis, they have a lot of expiring generic competition on their way, so this gives them access to new and novel drugs. The price tag, $72 a share, so we're trading just below that. Shares popping by 44.5%. You also mentioned the constructive talks after 2 days in Malaysia and the hope that that will lead to something big and a bigger agreement on Thursday when President Xi and Trump meet. We're seeing a lot of the tech companies react positively to that. NVIDIA being one of the biggest leaders in the Mag 7, shares are up 2.5%. Also, as part of that, Scott Besson saying that China would delay their rare earth regime for at least some time. And you see the American rare earth companies fall on that. Of course, these are the companies that had gained with the expectations that exports from China would be curbed, so you have to go American. Now we're seeing MP Materials, for example, fall 4.6%. Critical Metals falls 7.2%. John.
Danny, thank you. Appreciate the update. More on that a little bit later this morning. On our radar this morning, big move in Argentina. President Javier Milei's party securing a comeback win in Argentina's midterm elections, giving Milei a strong new foothold in Congress and allowing him to protect his veto and push through his free market reforms. Elsewhere, the US and China trade negotiators coming to terms on a range of points, including export controls, fentanyl and shipping levies, setting the table for US President Donald Trump and Chinese President Xi Jinping to finalize the sweeping agreement later this week. And finally, the US Transportation Secretary Sean Duffy warning travelers will face more flight delays and cancellations as the government shutdown continues.
What I see coming forward as we get to Monday, tomorrow, Tuesday, and Wednesday, that you're going to see more staffing shortages in towers, which means you're going to see more delays, more cancellations.
Air traffic controllers are set to miss their first full paycheck tomorrow. The pressure starts to build.
This is where a huge pressure point is mounting right now. You have more than 8,000 U.S. flights that have been delayed. Yesterday, LAX ground halt because of absentees, because of what's going on with air traffic controllers are not getting paid. And Sean Duffy was talking about the fact that these individuals are leaving their job, and to make ends meet, they're trying to find jobs at night, driving Ubers, becoming a DoorDash delivery individual. This is really an issue when it comes to the fact that we are just a few weeks away from November, Thanksgiving, when many Americans have to head to the airport and travel. And right now, neither Republicans or Democrats are blinking when it comes to the shutdown.
Elise, you've been talking to the airlines, United, American. What are they saying about what's just around the corner?
They're saying that so far there hasn't been an issue so far. And they're saying the longer this drags on, the more that they expect it to. But frankly, they don't exactly speak how they might feel, in the sense that they might have a lot of fear that people aren't going to show up. But air traffic controllers have already been under pressure with low staffing levels and low employment levels relative to the capacity that's needed. They don't want to deteriorate sort of morale further by saying it's your fault that we're all grounded. So they're trying to sort of toe a pretty delicate line here. When people start not getting paid, though, and we have to think that hundreds of thousands of people already have not gotten paid as a result of the government shutdown, things start to change, behaviors start to change. People need to take that time off from work so they can go drive an Uber.
The airline guidance into year-end kind of speaks for itself. they're going to be okay?
They're going to be okay, but I can say they do honestly recommend that this get concluded soon, because they are concerned that the longer this drags on, the more it will have a deleterious effect on airline profitability.
Joining us now to discuss, Terry Haynes of Pangea Policy joins us now for more. Terry, week 4. What's the date circled on your calendar when this gets real?
Oh, I think sometime right before Thanksgiving, I imagine. I've been saying since before the shutdown started that not only was this politically generated, but that Democrats had the ability to decide when it was finished by merely by agreeing to continue to negotiate on the Obamacare subsidy temporary increase, and so they can do that. And meanwhile, the pain will continue to mount, as you all have talked about, and neither side ultimately is going to want to be the primary blamed for all this. So I think you probably have a truce called sometime before Thanksgiving.
Terry, something interesting happened last week where you had the 2 Democratic senators from Georgia decide to vote with the Republicans, and also a Senator Fetterman from Pennsylvania, in paying essential workers like air traffic controllers. Are we going to see more of that?
Yeah, I think so. There's going to be a lot of kind of one-shot bills with different constituencies that might not be getting paid and all that. But underneath that, what that shows is a kind of growing disquiet on the Democratic side with the shutdown strategy generally. They're willing to give their leadership the benefit of the doubt, but that's also wearing kind of thin.
We also have elections upcoming November 4th, a big one with the New York City mayor race and also governor elections and Prop 50 in California. Is that going to affect how certain senators show up to vote maybe after the elections take place?
Well, I think it affects how the senators make known to their leadership the willingness to continue. I've been telling people for a couple of weeks now that this was not a political opportunity Republicans sought, but it's one that they'll now seize. What they want on next week in November is to be able to say to the public, look, the Democratic Party is now the party of Mamdani, the new New York City mayor, and you have I'm being Republicans here. You have Hochul and Jeffries and Schumer all kind of bowing to him, and that's the future of the Democratic Party. And then they also want to point out that the balloon likely gets let out of the Democratic centrists in Virginia and New Jersey. It's a little bit too much for them to hope that the Republicans win in either case. But what they will be able to say is, look, these people barely squeaked through in years where they should have done much better, and they haven't. So the air's out of that particular balloon, and what you got is kind of the Mamdani party. And I think folks, frankly, in Midtown Manhattan underestimate just how powerful a message that is in the broader public.
How much does the shutdown really play into local elections like that?
Not much at all, really. There is more in Virginia than in New Jersey because you have a contingent in Northern Virginia. I mean, Virginia's turned a purple state, but it has turned into a tale of two states. If you're in Northern Virginia, you're in heavy government employee territory, and outside of Northern Virginia, you're not. But Northern Virginians are already, by and large, heavily Democratic and motivated to vote for the Democrat Spanberger anyway. So I don't know that it makes a huge difference otherwise, although they're trying to pump up. Less so in New Jersey.
Terry, I'm wondering what you think of Congress being shut down. That the Congress hasn't come back to the table so far for another vote since, I believe, September 19th. And this has been a strategy for Majority House Speaker Mike Johnson, where he said, look, it's up to the Senate. The Senate needs to take action. Then Congress can get behind what they do. Do you think that has been a prudent strategy, or one that has really diminished the executive branch of the House of Representatives?
Oh, it's a very prudent strategy. I know I'm aware the New York Times thinks it's not, but by and large it is. he's got to herd cats every day. Johnson does, and giving the cats a playpen in Washington, well, with a lot of microphones and cameras around him, is an opportunity for mischief. So it's much better that he keep them out. It's also much better, frankly, for him that he defends kind of the institution of the House and what the House did on shutdown, and frankly say it's up to the Senate to figure it out. It makes it easier for him on those two levels. So I think it's probably a good idea.
Terry, what is the future of the Democratic Party? Can we just finish on that? Governor Hochul gets booed everywhere she goes. Establishment leaders down in Washington, D.C. reluctant to endorse the guys leading at the polls here in New York City. What's the future of this party?
They're going to have to have I was going to say a cleansing, and that's obviously a bad thought. But the idea is that they've got to come through both generationally and in terms of ideas. They've got to reconnect with people and not just pretend to. They've got to try to figure out how to move people forward. We've had a generation here, I'm indicting both parties by saying so. We've had a generation here where people have decided to play politics instead of solving problems. The party that gets back to solving problems first and best wins. There's a high perception that the Democratic Party now is the party of rich people and has completely disconnected from its working roots, and the Republicans have come into that hole. Democrats have got to get back to that and get back to figuring out how things ought to run and what they are actually for, or kind of all the Hollywood this or that or the other isn't going to make a difference.
Terry, appreciate it. Terry Haynes of Pangea Policy. Thank you very much, sir. I don't think you can overstate the importance of this upcoming election, setting the tone for elections still to come in this country for the next few years.
Yeah, especially because the Democratic Party cannot understand exactly what it is. And it hasn't really come up with a comparable message other than we're not Trump. And that doesn't fly. And we have seen that repeatedly. So it's a real question. Do they coalesce around the Mamdani kind of point of view? Or do they coalesce around something that is a more traditional institutionalist type of view? And ultimately, this is the fight on the Republican Party also. It just is being manifested maybe less successfully just by virtue of the polls and some of the results in the Democratic Party.
Well, this is why Zohran Mamdani has actually been successful. He hasn't made every stump speech about I am an anti-Trump person. He's actually made it about the issues New York City residents complain about. Why is everything so expensive? Why is rent so expensive? He has talked about affordability every single time. So has Bernie Sanders, and so has Congressman Alexandria Ocasio-Cortez. All three of them last night at Forest Hill Stadium, taking a huge bow to a sold-out stadium that came to see them. I mean, he is winning this mayoral race, and it's going to have national implications on this party.
Big time. The risk is their policies just make those problems a whole lot worse. Equity futures on the S&P 500 up by 0.9% this morning. Equities advance with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump oversaw the formal signing of a peace deal between Thailand and Cambodia. Trump attended the ceremonial signing event with the leaders of the two nations in Malaysia, which helped facilitate the talks. The president also announced a trade deal with Cambodia and a framework trade pact and critical minerals agreement with Thailand. And Barclays is heading back to Saudi Arabia. After exiting the region 11 years ago, the British bank has revealed it is in the process of securing a license to conduct investment banking activities in the country, alongside plans to open an office in Riyadh next year. Barclays follows similar moves from JP Morgan and Goldman Sachs. And President Trump is ruling out the idea of running as a vice presidential candidate in the 2028 election. He made the comments aboard Air Force One this morning, responding to calls from some supporters who've urged him to find a way around the Constitution's two-term limit. Trump has declined to rule out seeking another term despite that restriction. That's Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on our program, locking in the next rate cut.
The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens.
In a few minutes' time, we'll catch up with Veronica Clark of Citi from New York City. You're watching Bloomberg TV. Record highs on Friday, more in store this Monday morning. Good morning to you all. Equities up by 0.9% on the S&P, on the Nasdaq 100 up by 1.3%. Under surveillance this morning, locking in a rate cut.
We're not getting the public data, but everything we're getting is telling roughly the same story. The labor market's weak. Growth seems to be on the stronger side, which is a bit of a puzzle right now. You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens.
So here's the latest this morning. The White House naming 5 finalists to replace Fed Chair Jay Powell, including Governor Chris Waller, with the Fed widely expected to cut rates at Wednesday's meeting. Joining us now to discuss is Veronica Clark of Citi. Veronica, good morning.
Good morning.
Rate cut nailed on for Wednesday. Can't seem to find anyone who disagrees with that. How much guidance can they provide beyond Wednesday's meeting?
Yeah, probably not a whole lot. We haven't had any data, of course. I think if anything, the data that we have had, obviously CPI on Friday, should give them a bit more confidence that, inflation is slowing. Labor market is weakening, but they probably can't give us a whole lot of guidance right now. We have no data.
How comfortable should we be with the data we have got, which is inflation at 3%?
Yeah. It's not where the Fed obviously wants to be, but I do think they'll find some encouraging details in that data that we got on Friday. We had particularly soft shelter inflation. I think that will be an encouraging development. We haven't seen a ton of the tariff-related inflation. Maybe more of that is still coming, but I think this is slower details than they should be comfortable with. Yeah.
I thought also the owner's equivalent rent was really interesting. The fact that it came down to the lowest going back to 2021. I was looking at this thinking, okay, well, I can buy this story. And then a couple of people messaged me and say, all right, you numbskull, this is backward-looking data that was done over the past year and is completely lagging. And when you look at current indicators, they show something different. What's your response?
Yeah, I don't actually think the current indicators show anything that different. It is a very lagging indicator, of course. But when you look at all the forward-leading measures, Zillow, new rents, home prices have been falling for a lot of this year. It seems like that kind of trend can continue.
At the same time, you are seeing other points spike upward, in particular some of the good sectors, and you see a lot of companies saying that they're still going to pass along additional price hikes. At what point do you start to look at this and say it's not so clean? Even though we already knew it wasn't so clean, it's even more difficult to really discern what's going on.
Yeah, relative to how we were forecasting the tariff pass-through maybe 6 months ago, though, I think for most people, we have been surprised that we haven't seen more pass-through at this point. And I think that, unfortunately, does speak to consumers just can't handle these big one-time kind of price increases. It has to be spread out over many months, which could give the appearance that, inflation is maybe a bit sticky, but it's still that softer demand backdrop that means you can't pass on these big price increases all at once.
Doesn't it also mean that corporate America has been resilient in terms of mitigating some of the price hikes?
Yeah.
So what does it mean for next year? Do they start to maybe have to lay people off?
Yeah, I do worry that, the more you can't pass on the price increase to consumers, that is eating at profit margins for longer. We already know that businesses are trying to cut labor costs, and they've been doing that through not hiring anyone. But I would worry that you can only not hire people for so long before the next step is layoffs. We don't see the signs of that yet, but that is, I think, still a risk.
We're in this data desert with the 27th day of a government shutdown. We had the inflation on Friday, but that was one and done, according to the White House. How long could the Fed continuously cut rates if we remain in a government shutdown and don't have data?
Yeah, it's getting tricky, obviously, because there is the division among Fed officials, a group of people who maybe don't want to cut anymore at all, and people who want to cut each meeting this year. It is hard, but I think the shutdown itself, if it really is lasting that long, that is a drag on growth in itself.
Except we won't see the data. That's where the risk management argument loses some oxygen, I think, in the next meeting in December. If you don't have the data to convert the hawks on the committee, how are they going to vote? And how are they going to forecast into next year?
We'll have to deal with the data that we do have. Obviously, we'll have the surveys. ISMs probably get more important. The Fed will probably put more weight maybe than I would on something like ADP employment. But yeah, it is tricky.
Are you seeing sufficient deterioration in the other indicators?
It doesn't seem like we're getting that break yet. We fortunately, probably one of the best data points to have, we are getting claims. We are getting the weekly jobless claims data. We just have to aggregate it ourselves from the states. We have seen continuing claims starting to tick up again. Initial claims are still low, but that's going to be an important one to watch.
Well, let's sit on initial claims. Does that give you and the team pause? that maybe the labour market's not as bad as you and some of the doves on the committee thinks it is?
Yeah, it is tricky. We're getting into the time of year, which this happened last year also, where there is this residual seasonality pattern in the data where we had the weakness in summer 2024 and then things seem to stabilize. I think that seasonal pattern comes from this lack of hiring. This is a time of year when you're not usually hiring a bunch of people, but you're not laying anyone off either. The issue is when we saw that happen last year, it never got better, right? We just repeated it this summer.
How much does the QT plan really matter, the balance sheet? And there was some flirting with that in some of the recent speeches from Fed Chair Jay Powell, that they were planning on stopping some of the shrinking of their balance sheet. Is that important to understand what the directionality is for them in terms of policy?
Yeah, I think maybe my takeaway from it is just a lesson that the Fed is extra cautious, right? When we started to maybe get to the point where maybe reserves are not so abundant, maybe they're just ample, they're maybe talking about ending it earlier. I don't think they'll announce anything this week. It's maybe end of this year into Q1, but they are extra cautious when it comes to everything.
What's the takeaway from you and Andrew, that you've had an ultra dovish Fed for a long time, you've had inflationary shocks, you have an ongoing inflationary shock, and that the knee-jerk response is to risk manage to the downside in the labor market, regardless of what John was talking about, that 3% inflation rate? How do you understand why the market isn't pricing at a greater degree of inflation longer term?
Yeah, I mean, it maybe speaks to some confidence in the Fed, right? We haven't seen long run inflation expectations going higher. If we did see that, obviously that's a game changer. But I think the market is taking what we see in the labor market data, and that is not a scenario that creates inflation, right? A weaker labor market.
It's been a huge freak out about the erosion of institutional credibility. It's just when you look at market-based indicators, don't quite see the same thing.
At all. I mean, if you take a look at long-term inflation expectations, they've come down in the 10 years, the cleanest read on that. I just thought it was notable. In an interview in the Financial Times over the weekend, Scott Bessent talked about his strategy. What he said is, we want the most America First policies that are possible without incurring market wrath. And he was saying, unlike most of my predecessors, I have a very healthy skepticism of elite institutions, but I have a healthy regard for the market. And that is very much a focus of as he goes through crafting policy.
Yeah, and he almost felt vindicated in that interview. He was talking about where the hell is the market risk. He's looking at basically all-time highs when it comes to the S&P 500. I also think it's interesting when it comes to the Fed. The president told us we're getting a Christmas gift end of the year. We will have a name by the end of the year of what next year potentially policy path forward will look like.
I think the Treasury Secretary's done a good job of buying time on that issue. Just stretching things out, delaying things into year end. There was a feeling at one point in the summer you'd get that decision maybe around September time. It's been pushed out a number of months.
But remember, that's when they were jawboning Mr. Too Late, Jay Powell, and the president had called him. Now that the Fed is cutting, I think it's the Fed that gave the Treasury time to make this process a little bit longer than they were expecting.
Just quickly, Veronica, of the names on the screen, you and the team got a pick yet?
No.
Don't want to go there?
No opinions, yeah.
Too soon. OK, Veronica Clark of Citi. Rick Reed is still in the mix. We're down to 4 or 5 names. It's a decent, solid group of names.
Yeah, we've been down to this 5 group of names for about, 2 months now. I mean, the funny thing to me is that they are prolonging the discussion in the popular narrative, that they want to keep the pulse of there is going to be another Fed chair, but we're not going to undermine Fed Chair Jay Powell just yet, because ultimately it will be a test of the new Fed chair. This is a great, kind of exercise in gamesmanship.
Going to be playing this game into year end. Coming up on the programme, Brian Nick of New Edge Wealth, Jeanette Lowe of Strategas, Vito Spaduto of RBC Capital Markets, Greg Peters of PGIM Fixed Income. The second hour of Bloomberg Surveillance up next.
Have a very resilient and robust economy.
Heck with robust. I will take resilience is what I like.
Inflationary pressures outside of, some tariff-related pass-through are pretty benign.
The Fed would be well served to be very cautious in this environment.
The Fed will become increasingly under pressure.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs into the weekend. We're looking at record highs on the cards this morning. Equity futures up by 0.9% on the S&P, on the Nasdaq up by 1.3. Equities up, bonds down, yields just a little bit higher throughout most of this morning on 2s, 10s and 30s. 10s up 2 to 4.02. Going into just a monster week. Earnings, loads of them from tech. A Federal Reserve decision coming on Wednesday. The day after that, a meeting between the leaders of the two largest economies on the planet.
It's truly all of the main themes of this year wrapped into 1 week with a lot of activity. You've got the tech boom and how much you can see the ratification of that with the big tech names reporting, Microsoft, Alphabet, and Meta on Wednesday, and then Apple and Amazon on Thursday. Then there's this question of how does the Fed respond to a data desert? They will respond by cutting interest rates, but can they guide beyond that? And then there's this question about whether you do get a true resolution in some of the trade tensions between China and the U.S., and then whether we've priced out all tensions already based on some of the market moves this morning.
The tone over the weekend just so much better. Secretary Besson offering us a guide into this meeting on Thursday, and the president almost doubling down on it on Air Force One.
Yeah, the issue I have with this is this really a deal or is this a delay? It feels like it is a trade war postponement when you think about the fact the Treasury Secretary is saying that the rare earth export controls are being deferred on the Chinese side for maybe a year. So this story is going to bleed into 2026. What we have right now is basically coming back to where both these countries were in May when it comes to the tariff levels, except maybe on fentanyl, and when it comes to rare earths.
Mark is comfortable with that. Doesn't want resolutions, just does not want additional problems going into year end, particularly at a time where a lot of corporate clients have re-engaged. The spending has continued, and there's a real sense there's a ramp, or could be a ramp, into 26.
It's so funny to me that we hear a greater degree of certainty from every company that we talk to, from every investment manager that we talk to, and yet we're still talking about the same trade issues between the U.S. and China and a potential ratcheting up and ratcheting down of the same heated issues over and over again. It just raises a question. Are people understanding that both sides are not going to necessarily mutually assure destruction of one another's economies, and they're going to come to some resolution that isn't going to cause a fissure in the relationship? And I think that really is what people want to see, that status quo continue this week.
Big bounce this morning, up by 0.9% on the S&P 500. Coming up this hour, Brian Nick of New Edge Wealth with futures climbing ahead of big tech earnings. Jeanette Lowe of Strategas as the US and China close in on a trade deal. And Greg Peters of PGIM with the Fed flying blind into their next interest rate decision. We begin this hour with stocks at record highs with the Mag 7 facing an earnings test. Brian Nick of New Edge Wealth writing, we are following upward earnings revisions, not rising valuations. Brian joins us now for more. Brian, good morning.
Good morning.
How resilient is the bull case into this week?
We think the earnings case is resilient. We wouldn't be betting against good earnings reports, not just this quarter, but in the quarters ahead. And we think that especially the Mag 7 and tech generally, the expectations for 2026 look pretty reasonable. It's the rest of the market that we're a little bit more concerned about, with the 30 or 40% expectations for smaller cap companies to grow earnings into 2026. We don't see as much scope for that. So we don't want to be quite as concentrated as the market, but we don't mind being in tech.
Well, let's take last week. Cyclical tilt, outperformance in small caps. Another head fake?
The problem with the small cap trade is there's two things going on at the same time. There's the general optimism with interest rates coming down, with the economy looking resilient in the absence of data. And then there's a speculative trade, which seems to be correlated more with things like precious metals and just tends to be lower quality in nature. We don't want to be in companies that are not profitable, where the valuations, as we said in the quote, are rising without any earnings. We saw some of this in China, too. One reason we've taken some China exposure off, the same kind of reason. We've seen this 30% rally in a single quarter. That's where we're taking some risk off the table. We'd rather be in something like the S&P 600, which has some tests around profitability, quality, rather than the Russell 2000, which has really been driving things over the last 4 months.
Why is momentum not a leading indicator? Why is the fact that momentum, the sort of less profitable companies and some of the meme stocks and some of the more inflated trades losing steam, not a warning sign to the rest of the market and sort of an idiosyncratic hole that people are shrugging off?
I think it's because the other indicators on positioning on sentiment don't look quite as frothy as the high momentum trade. If you look at the AAII, individual investors still don't look overly bullish on this rally. If you look at positioning, it doesn't look unusually stretched, maybe slightly. So the other things, that if we had all those things flashing red, I think that would be more of a concern. And again, we're not enthusiastic about chasing the momentum stocks here. Typically, momentum's having a really good day. Our strategies are not doing as well. We want to be in the higher quality areas that are waiting for the earnings reports to come in because that's what's going to tend to drive the results.
What are you looking for with the Magnificent Seven stock results? I mean, the earnings results. We're expecting to see some kind of $360 billion in CapEx spending from the likes of Microsoft, Alphabet, Amazon, and Meta so far this year, $420 billion next year. Is that a good thing? Is that a bad thing? How much are you depending on it going up or going down? What's your sort of tell?
Yeah, it has to be. It's sort of a perpetual motion machine at this point, right? We need to see continued forward guidance looking positive, continued plans for CapEx among the hyperscalers, and then continued profitable sort of outlooks for the NVIDIAs of the world and the chip makers. So all these things are sort of mutually reinforcing. We don't think that's a bubble for now. It's certainly not a bubble in valuations, but we think it ends up being potentially a bubble in earnings down the road. The expectations can't keep ratcheting up, but we think for now, with the economy, with the beneficial sort of Fed cuts happening, and with all signs pointing to generally good risk appetite among investors, that this is going to keep going for a bit.
Brian, you're punting. What does for a bit mean? What's the timeline?
We don't have a recession call. Certainly for this year or for early 2026. So that means in the absence of a recession, we think this market continues to move up. The rest of the economy to us doesn't look nearly as good. We're not seeing it in the data because the data is not coming out. But when you look at the ADP numbers from last week, the smaller companies, and I think one thing I'm going to be looking at this week is the Dallas Fed manufacturing survey, not just the survey, but the comment section. Those business owners have been pulling their hair out about tariffs and about interest rates. And those people are not part of the Mag 7, right? They're not going to be reporting earnings, but those companies are hurting because of the underlying economic conditions. So the market and the economy are, again, two very different things for us.
So is your expectation that even if we don't have data, the Fed continues on a rate cutting cycle for this year?
Certainly for this week. I think we will start to have data by the time the December meeting comes along. That's our expectation. So in the absence of any kind of break in the trend, it looks like they do continue to cut interest rates. The market may be overpricing rate cuts for next year. Again, unless the labor market falls apart, in which case we are dramatically underpricing the degree to which they will ease. And this is why we are not rooting for more rate cuts, because more rate cuts from what's priced in means that the economy has tipped into recession, if not something close to it.
Just want to pick up on something you said. The market and the economy are not the same things to us. It's an important distinction to make, an obvious one at times as well. Are there limits to that for you and the team?
Sure. So you look at things like how much of the economy is being driven by capital expenditures on things like software and hardware related to AI. Part of it is that the money that's going there, if in the absence of an AI boom, would be probably going to other areas. There'd be more construction happening on the residential side, more construction happening generally on the commercial side. So we don't think that this economy is over leveraged at the moment to AI, because there's a lot of momentum behind the CapEx there, and it's probably stronger than it would be in the absence of AI. But there's things that are crumbling around the edges, like how many people are getting hired, how easy is it for businesses to find workers. The fact that those two things can happen at the same time tells you there's something not quite right in the underlying economy. It's not being exhibited in the stock market and not in the credit markets either, which have recovered pretty impressively from that one kind of Friday we had.
So what you have to see to really get behind the broadening out trade, right? I mean, we've been talking a lot about when is that going to start? When are we going to start seeing the benefits of all the CapEx spending from AI and the benefits from some of the efficiencies of scale move out to the rest of the economy and become an economic story? What are you looking for to understand that?
We'd like to see hiring picking up. We'd like to see the absence of layoffs in the next quarter or two to let us know we're kind of out of the woods and we've kind of achieved that, whatever we were talking about, a soft landing now for 3 years, but we get there. That's really when the broadening trade happens. If you think you're late in the cycle and things are continuing to get worse, that's not when things tend to broaden out, right? That's when you're moving from cyclical to defensive. You're going to move from extremely broad to extremely concentrated. So it's really going to be in the labor market data of the next couple of months that tells us whether we are sort of softly landing here, asymptotically approaching a sustainable rate of growth, or whether we're going through that rate of growth.
Brian, aren't these two things, though, tethered together? An AI boom. Doesn't that mean we are likely going to have a weaker labor market? Because isn't that the whole point of what AI is doing?
Typically with these kind of technological breakthroughs, you don't see people losing their jobs en masse. So whether it's mechanized farming, whether it's the internet, industrial age, you tend to see people just start to move differently, work differently. There's different areas that produce jobs. We have never been in a situation where we've had job losses because of a technological revolution. This one, you would need to see a lot of productivity growth. If you believe that AI is affecting the economy, you need to see a lot of productivity growth, which would mean maybe absence of hiring, but very strong GDP growth. And that might mean, all else equal, that people's wages should be going up. even if there's not strong hiring, because the types of jobs that people are doing are now higher value because AI is probably going to be taking care of the people that are doing kind of more rote jobs or jobs that can be easily automated.
I hope you're right. There's just a sense, and Luke Cow has written about this, he's done fantastic work, I think, that it's regressive up front, that it's causing some hesitancy amongst employers and hiring managers to know what to do here because it might be a wasted hire, and it's also pushing up electricity prices across the country. So I hope you're right, you hope you're right, I think we all hope you're right, but in the near term, we've got a bit of a problem, potentially.
Yeah, and this is the reason why it's important to understand how companies are starting to deploy this. Is it just saying, well, instead of hiring somebody that we have to train and spend time on, we can just chat GPT it and have a good day while energy prices go up? Then it's a problem. If you have a systematic way of trying to deploy it through the workforce to try to understand what efficiencies you can produce, well, then that might be more of an issue down the line, but it might have less regressive effort, at least up front.
It's a happy conversation for your Monday morning. Equities here at all-time highs on the S&P 500. Brian Nick there of New Edge Wealth. Brian, thank you.
Thank you.
Good to see you, sir. Thank you very much. Let's keep an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. A U.S. military helicopter and a fighter jet crashed in the South China Sea about 30 minutes apart on Sunday. The U.S. Navy said a Seahawk helicopter went down while conducting routine operations just before a Super Hornet crashed. The Navy said all 5 people involved in the incidents were safe and investigations are underway. Meanwhile, Canadian Prime Minister Mark Carney says his government is prepared to resume trade talks with the U.S. at any time. President Trump said last week he was calling off the talks and imposed an additional 10% tariff on Canadian goods. Trump was angered after the province of Ontario aired an anti-tariff ad featuring former U.S. President Ronald Reagan. And 2 men have been arrested in connection to last week's major jewel heist at the Louvre. One suspect was arrested at Paris's Charles de Gaulle airport while trying to board a plane to Algeria. And the second was arrested as he was about to travel to Mali, according to police. The French National Police are still searching for 2 other perpetrators. That's Bloomberg Brief. John?
Yahira, why would you go there? To Charles de Gaulle? It's like the last place I would go.
It sounds like these were sort of amateurs. They left a construction vest somewhere. Did you see that the crane that they used?
They left a crown, too.
Yeah, they left the crown. They dropped the crown and damaged it. But did you see that the crane that they used is this German manufacturer that is now using this as an advertisement? They're saying, you know, look, it can be brought anywhere, and it's effective.
Europe has such porous borders. It's so easy to get in. How did they find it so difficult to get out?
Well, again, amateur hour.
You know?
Work on it.
I can't wait for the movie.
We know how it ends now. At an airport. Charles de Gaulle, apparently. Up next on the programme, closing in on a deal.
We're going to have a great talk. I have a lot of respect for President Xi. I like him a lot. He likes me a lot. I think we're going to have a successful transaction.
That conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning. Following the biggest one-week gain on the S&P 500 since August, equities add some weight to the rally, up by 0.8 on the S&P 500. On the Nasdaq, up by 1.2. Under surveillance this morning, closing in on a deal.
What we understood yesterday or 2 days ago or even today is not going to be necessarily what it's going to be in 2 days. We're going to have a great talk. I have a lot of respect for President Xi. I like him a lot. He likes me a lot, I believe, and respects me, and I think he respects our country a lot. And I think we're going to have a successful transaction for both countries.
So here's the latest this morning. President Trump and the Chinese leader gearing up to finalize a trade deal this week as top negotiators from both countries agree to a framework. Tyler Kendall joins us now from Tokyo, Japan, for more. So Tyler, we heard from the Treasury Secretary over the weekend as well. It sounds like China's going to buy soybeans. Also sounds like they'll delay restrictions around things like rare earths. What is the US conceding in return, if anything?
Well, John, at this point, it seems like both sides are trying to tee up some diplomatic wins, but we should caution that still some of those main issues of conflict remain unresolved. Now, it appears that the U.S. is going to take off the table that threat of an additional 100% tariff, effectively meaning that we're likely expecting this extension to the tariff truce that is currently in place in exchange for these concessions that you just outlined, including the purchases of soybeans, as well as a review of the recently unveiled export curbs related to critical and rare earth minerals. China has also said it's expecting the U.S. to no longer impose fees on Chinese ships that are docked at U.S. ports. And while the U.S. maintains that it's not going to change any of its export controls related to advanced semiconductors, our own analysts at Bloomberg Economics say that the U.S. is likely going to take off the table some of those proposed, those threatened but not yet imposed export controls and restrictions related to critical software and also cloud computing. But you're right, at this point, those top lines are that we're seeing a pullback of what has been recently threatened in recent weeks, but not really progress when it comes to the broader trade framework. But John, that's why I'm watching really closely what happens to that 20% tariff that's tied closely to fentanyl, because that tariff has been in place really since the beginning of the administration. It was one of the first tariffs imposed back in February, and both sides are saying that they are making progress when it comes to that issue. So potentially we could see some sort of concession there.
Tyler Kendall with the latest. Tyler, thank you. And good evening to you, of course. Good luck with your travels over the next few days. Joining us now to discuss, Jeanette Lowe of Strategas. Jeanette, so we know what the president's priorities are. He's articulated them pretty well. Fentanyl, soybeans, rare earths. What does China want on the table for Xi Jinping this coming Thursday?
Yeah, I mean, obviously, China has been pushing to show that it has a lot of leverage in these talks with the rare earth export restrictions that it proposed. And obviously, one of the things that they have been talking about is whether or not they could get some sort of deal on the U.S. stepping back on its support for Taiwan. That has been something that has been proposed in the past. Obviously, Secretary of State Rubio put, kind of said that it was off the table in these talks. I think, obviously, though, the bigger picture here is that the U.S. and China are kind of trying to keep maintaining the status quo in their relationship. So we keep talking about having soybean purchases, and we're talking about making sure that there is still access to rare earth mineral exports and things of that nature. But we aren't making a lot of significant progress on other issues. Now, as Tyler mentioned, if we were to actually see that 20% tariff rate for goods for fentanyl that have been placed on Chinese goods, that would actually be significant. That would be a big upside if that actually were to come to pass. But we were focused on the fact that the U.S. is really trying to de-risk from China in critical areas like critical minerals. That has been what this has all been about to some extent, to show where the U.S. has over-reliance on China and where it needs to actually step back and try to develop new relationships. And you've seen that repeatedly over the past week with the U.S. making deals with Australia, doing deals potentially with Malaysia to try to focus on critical minerals. So there is also this focus on trying to de-risk in these critical sectors while we're maintaining the status quo in the U.S.-Chinese relationship.
Well, the Treasury Secretary says China is going to give a year basically as a deferment when it comes to the rare earth export controls. How much can the U.S. make a dent into China's stronghold on rare earths in a year's time?
Absolutely. And that's a really good point. I mean, obviously, a year would be much better than 90 days, which is kind of the framework that we've been working under for the past 6 months or so, where we keep having 30-day deadlines and then the U.S. and China have to talk. And there's always been this risk since back in April that China does withhold these goods. And that's really important. Obviously, a year is probably not enough time to make significant progress. But I think one of the things that is interesting is that the Trump administration is trying to rebalance this relationship. And you cannot remove the entire reliance within a year. But one thing I thought was really interesting in looking at the deals that were announced with Malaysia and Cambodia was that the U.S. is also trying to put other pieces of its agenda into these agreements. So having those countries ban goods that have been made with forced labor, that is a target at China, having them try to adopt similar measures to what the U.S. adopts with regard to unfair trade practices. I thought that was quite significant. So they're trying to get other countries to also focus focus on China, the fact that it can evade U.S. tariffs by doing transshipment of goods through other countries. They're trying to do this in all of the trade deals that we've seen, focusing on rules of origin, focusing on transshipment of goods, trying to actually increase investment restrictions on China and other countries. So there is still this rebalancing act. Obviously, it is going to take quite a bit of time, and that's also why I'd be a little bit surprised if there were to be a lowering of tariffs on China in this agreement.
Next week, the Supreme Court's also going to be hearing oral arguments when it comes to legality of Trump using IEEPA to enact these tariffs that he has on China. Is that playing into these trade talks that are happening this week?
I mean, I think it probably is to some extent. I think the administration probably wants to have some of these deals in place before any decision comes down. Now, we may not have a decision until January or February of next year, but I think he's trying to get these agreements in place so that even if there was the potential for tariffs to be overturned, maybe he could point to these deals saying, let's keep these in place and not have to rework the tariffs in another way. Obviously, the administration does have a backup plan. So if the Supreme Court were to overrule the tariffs, they have a two-step process to reimpose them, doing a balance of payment tariff for about 150 days while they do Section 301 investigations into countries' unfair trade practices, to then reimpose the tariffs that essentially we have today within 4 to 5 months' time. But I think trying to get these agreements in place now also allows the administration to then say, we can keep these agreements in place rather than going that backup route and having to do a whole new investigation and potentially even see higher tariffs.
What have we learned in terms of the agreements that have already been struck or the frameworks that have come out of the meetings over the past couple of days with Malaysia and Cambodia, the expectation for Vietnam and Thailand? Are we expecting some sort of amelioration of the source of origin issue, the idea that potentially some of the goods from China, materials that go into their output to the U.S. could be tariffed at that 40, 50% level? Do you have a sense of whether the U.S. is forcing some of these countries to choose between the U.S. and China?
The U.S. is trying to do that. The U.S. is trying to push countries. We've seen it when the talks with, if you think about what's been going on with Mexico in particular, the fact that Mexico is now increasing tariffs on goods from China, as well as other countries with which it does not have a free trade agreement, that is kind of speaking to this rules of origin issue. The fact that the Malaysia agreement also had things like making sure that they are abiding by U.S. export controls and trying to prevent goods that would be restricted to China from the U.S. side, also on the Malaysian side. So they're trying to do that. Obviously, it's not going to be easy. These countries have also had good relationships, closer trade relationships with China. So it's going to be hard to unpack over time. But you are definitely starting to see movement. Now, the 40% transshipment tariff that's been threatened over any of those goods, we haven't seen that announced yet. I think it was also interesting that while the Trump administration kept all of these goods tariffed at a 19% rate for Malaysia, Cambodia, Vietnam, and Thailand, currently there are some restrictions being lifted. So there was exemptions for certain goods that are not produced in the United States that could come down to zero. And maybe over time we can see some more forward-moving progress. But this is all going to take quite a bit of time to actually get any sort of reordering of U.S. trade. And I think that is ultimately the administration's goal. So it's going to take some time before we actually get there.
Jeanette, appreciate it. Thank you. Jeanette Lowe of Strategas. The tap dancing continues. I think there's two big objectives here. To de-risk without much disruption, that's one. That's ultimately what the US wants to achieve. Get rare earths ready, the refining capacity ready domestically without the disruption caused by the Chinese in the meantime. But the bigger one for the global economy is to get the Chinese economy to rebalance and move away from this overcapacity to boost consumption. We have been talking about this now for well over a decade. And you can see it in the trade numbers, Bramo. Fact of the matter is, tariffs are super high relative to where they were at the start of the year, and China is still on course to run a record trade surplus for 2025.
And if you take a look at the earnings of European auto manufacturers, you can see it show up. And that is where a lot of these goods are being shipped. You can see this in other countries as well. So right now, there's a shell game going on. Who's going to be allies with who and who's getting hurt versus being helped in terms of inflation and the disinflationary ramifications from this. This is a huge issue for the global scale. And you could say maybe we're not making progress, but in some ways, there is a coalescing of a certain degree of allies saying something's got to shift.
The Europeans are getting absolutely decimated by this. Up next on the programme, Vito Spaduto of RBC with M&A deals hitting new highs. Plus, Danny's got some morning movers for you. Shares of Dr. Pepper higher after a boost to their outlook. The stock is up by 5.5%. 2 days of gains on the S&P 500, adding some weight to it this morning, up by 0.8%, a record high Friday. We're on course for record highs later on this morning when this market opens at 9:30 Eastern Time. On the Nasdaq 100, going into tech earnings later this week, higher by 1.3%. In the bond market, going into a Fed decision on Wednesday, lots of debt supply. 2-year bond yields this morning, 350, up by 2 basis points. 10's up 3 to 4.03 as we start to get more of a constructive tone around US-China trade talks. That's the number 3 issue. Not in any necessary order. Got earnings, Fed decision, and that meeting later this week on Thursday between Xi Jinping and President Donald Trump. As we count you down to the opening bell, let's get you some morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Over the weekend, a victory for Milei, the president of Argentina's party. So just tracking what some of the U.S. ADRs and other Argentinian exposed stocks are doing. A great way to do that is the ETF, tracking it here in the U.S. pre-market. It is up 16.5% confidence that that victory will allow the economic reforms to continue in Argentina. Behind that, with the support of the United States. So those shares gaining there. Some deal news to work through as well in the past hour. Huntington announcing that they will be buying Cadence Bank in a deal worth over $7 billion. The floodgates are open for regional bank deals. We also had Huntington just last week actually close another acquisition of Vertex, another financial services company. Just last week it had closed that, so now it's going in. Cadence Bank shares up just under 2%. Finally, we got earnings from Keurig Dr. Pepper, and it was a raise to their outlook for net sales for the entirety of the year. The earnings for this quarter were strong, too. Interestingly, it was because prices were higher for coffee. Volumes were actually lower. Also off the back of this, they announced that they would be getting a $7 billion investment coming led by KKR and Apollo in the spinoff that they're doing of their coffee unit, and they get a minority stake of that. So shares up about 6.25%, John.
Danny, thank you. Did you watch the race over the weekend?
Of course, always watching every single race. It was chaos and it was wonderful.
Who's going to win this, Danny? Who's going to make this happen? Formula One world champion.
I thought it was Piastri, but after last weekend, I think it's Norris. I think Norris has this.
T-Max. That's what they call him, Max Verstappen now. T-Max. Danny, thank you. Thank you very much. Let's give you an update on stories worldwide. On our radar this morning, Argentinian President Javier Milei's party winning a critical midterm vote. The result strengthening Milei's foothold in Congress, allowing him to pursue free market policies with billions of dollars in backing from the Trump administration. Elsewhere, the New York City mayoral election is just over a week away. With the Democratic Socialist Zohran Mamdani leading the polls, he's working to make inroads with the business community and holding meetings with lobbying groups and bank CEOs, including Jamie Dimon. And finally, the Treasury Secretary Scott Bessent announcing the top 5 finalists to replace Fed Chair Jay Powell. Bessent says he's planning on a second round of interviews, and President Trump saying he could announce the nominee before the end of the year.
I think it's interesting it hasn't been done already. And I think that speaks to the idea that keeping this question mark around the Fed is probably beneficial to this administration. I keep going back to that Financial Times article with Scott Bessent, the Secretary of Treasury, where he's talking, Treasury Secretary, where he said, we want the most America First policies that are possible without incurring market wrath. And you look at long-term inflation expectations, and it speaks to Fed credibility and this idea that maybe people are really counting on him to pick a Fed chair that will have credibility with the markets, not just the president.
I also think we need to remember that the Treasury Secretary is not on this list, but at the same time, the longer this goes on, if Trump at the end of the year doesn't like these 5 candidates presented to him, is there more of a potential that the Treasury Secretary ultimately is forced to go do this job?
How familiar is he with all those names?
The Treasury Secretary, very
the
familiar.
President.
The president, familiar with, I would say, 3 of them, especially Kevin Hassett. That's his National Economic Council director. Sees him on TV all the time, carrying the flag on what the Trump administration is doing. He obviously knows Governor Waller because he was appointed to the Fed during Trump 1, but others not so much. The person he knows and trusts a lot, and in that Financial Times story, Senator Dave McCormick was talking about this to the Financial Times. Scott Bessent is the person that President Donald Trump really trusts when it comes to the economy in this administration.
That's what I was getting at. That's why that name still kind of lingers in this conversation, even though the Treasury Secretary is not exactly entertaining it. The race goes on. We'll find out year-end potentially over the next few months. Got to talk about this market and the amount of M&A activity we've seen over the summer and into the end of the year. Over $900 billion in deals completed so far this year, with another $1.1 trillion in the works, on pace for a 59% rise from a year ago. Vito Spaduto of RBC Capital Markets US writing, the market tone has shifted from waiting for an optimal window to moving into execution mode. More discussions of large deals, more preparation, more momentum. Vito joins us now for more. Vito, good morning.
Good morning. Good to be here.
We spoke only recently. Are things picking up even more over the past few weeks?
I just think about the past. I was here at the beginning of the month, and just the tone, as was just talked about, has clearly shifted. We've gone from trying to time the right window, and we always talk to clients about the importance of being prepared to execute on your strategic initiatives and being prepared to access the window when it opens. Well, the window feels open, and I think we're into full execution mode with many of our clients.
Could you give us a sense of how much it's accelerating?
Just to give you a sense, in this past couple of weeks, the volume year to date, both from a global perspective and from a U.S. perspective, has exceeded full year last year. So just to kind of, and we've also seen where total volume was up about 28 to 30%. Globally and U.S.-wise at the end of the third quarter. We're now talking about up 35 to 38%. We've seen some larger deals announced, especially across the technology space, the healthcare space. But more importantly, we've also seen the tone of the dialogue out there has become more active. Clearly, there's some larger companies talking about divestitures, strategic initiatives, publicly announcing that they're considering alternatives. And so those are all, big signs. At the same time, I would still label it as a cautious environment. I'm not seeing clients cut corners. I'm not seeing them rush into something. I think boards are certainly checking, dotting every I, crossing every T. They're making sure they've done their full diligence. They're making sure that the financing they're going to use is buttoned up, especially as we're heading into an environment where maybe there's some concerns about some of the financial structures that have been used historically.
So this to me is fascinating, the idea that you're seeing something, and it speaks to what people talk about with AI. It looks frothy, but it's not a bubble yet. Yeah. M&A, it looks like it's getting really heated, but it's not a bubble yet. It's not really problematic yet. And I just wonder, what's the motivation behind this? Is it because you are seeing the expectation for Fed rate cuts? Is it because there's more policy certainty? Is it just catch up?
Yeah, I think it's a clearer environment in terms of being able to execute on your strategic initiatives. From a government perspective, a regulatory review perspective, we're seeing clients consider transactions that maybe 9-12 months ago they would not have stepped into because they were concerned about would the government approve this transaction. And so I think there's been a more constructive tone out of the agencies. We've seen them certainly accept remedies, much more so in terms of you go into a transaction, you say, well, this might be an issue, but I'll consider these divestitures to satiate the regulators. And I think that's become an environment where you can think about how to constructively do something.
Are there particular industries that you're seeing robust activity? Is this the banking industry? Is this the tech sector in particular? What are the deregulatory areas that are kind of getting juiced by the current landscape?
I mean, as we talked about last time, it's always technology and healthcare. And you look at the Aligned Data Centers deal and Hologic in the past month or a few weeks as two of the largest deals announced year to date. And they highlight those two sectors are always leading the pace. We're seeing some around energy. I think we're seeing a fair bit around financial services. We certainly saw a significant bank deal announced this morning. I think there's more being talked about there. And I think that's an area where if you look at what the regulators from that perspective are considering, they're allowing more of those to come together.
When it comes to the government shutdown, has it been an impediment yet?
Not yet. I think it's noise that's being monitored. On November 5th, it'll become the longest shutdown in history. I think we talked about it last time. The poly markets now are betting, I think it's 52% is going to be November 16th or beyond. I think the vacuum of data is starting to cause some concerns because I think it's becoming more about expectation and estimates as we're seeing, what's going on there. We're going to hear a Fed decision later this week, likely to be a rate cut again. And so I think part of it, the longer it goes on, as soon as we start seeing, we joked earlier about, how many flights people are on and the fact that you're starting to see some delays, whether it's over the weekend and a lot of the business travel going on. Government employees are starting to miss paychecks. I think more and more of that happening, you're going to see it impact things. And certainly, when you start getting longer, you start impacting GDP going forward. Now, there's always an argument that you recapture it at some point, but that starts to become a concern.
You mentioned the Federal Reserve. How relevant are those rate reductions to the broader story of the acceleration that you've articulated?
Yeah, we talked about it last time. I mean, I think it's helpful. I think it's a good signal. But I also think when you look at the overall environment and what people are thinking about, there was a CEO confidence survey that just came out a couple of weeks ago from the Conference Board, and it was basically flat to the third quarter. It's sort of there's a strong view going forward, but it's certainly cautious, and it's right at the midpoint at about 48, where 50 is kind of the neutral level. But when you looked at what CEOs identified as their number one concerns, it's geopolitical instability at the top of the list. Trade and tariffs was up there, and it dropped to fifth. The other ones that they are concerned about is the uptick in sort of innovations around AI and how they impact their businesses. And so when you look at what CEOs are thinking about, even though they might not be impacted by geopolitical issues somewhere else, they're still thinking about it. It's that noise externally.
Financial conditions just is not the complaint right now. Credit spreads are super tight. Equity markets, we've been talking about it all morning, sky high.
Yeah, right now it seems like there's a window that's open, even though you've got benchmark yields above 4% if you look at the 10-year. I mean, it just sort of goes to this question of what is it that could potentially stymie some of this activity? And does it suggest that maybe this is closer to neutral than anything else because companies are able to adapt to this?
Well, I think the other thing is start noticing what's the commentary is when earnings announcements are being made. You hear mention of the shutdown, but you're not hearing about the significant impact on their businesses. I think you're hearing some caution and saying, well, maybe, quote unquote, are we in a bubble, or should we be careful what we're taking on? But they're still proceeding. So they're thinking about it, and I think everybody has a lot of history here and doesn't want to be caught as the party that's jumping in at the last minute when things are going in a difficult direction.
Have you seen the leverage cycle start yet? Have you started to see that come into some of these deals?
A little bit. I think the larger deals are set up in an appropriate fashion because the largest players in the credit cycle or the credit environment are participating in those transactions. I think when you're hearing some noise in places that have had issues from a financing structure perspective, it's really been some ancillary players that have been in those transactions, and so it's been less of a concern. But, Jonathan, I think we're sitting here with corporates probably the healthiest that I've seen them in decades. And again, you go through the financial crisis, you go through COVID. COVID demonstrated there was a resilience in balance sheets and also a resilience in business models. Where you learn to pivot quickly. You learn not to just take one path going forward. You thought about multiple paths, and you were able to make decisions and move your business. Think about earlier this year and how quickly a lot of companies shifted and brought business, back on shore, and you don't hear that tone as much anymore.
Vito, it's good to see you.
Great to be here.
Thanks for being here. Vito Spaduto there of RBC Capital Markets US with an update on stories worldwide. With your Bloomberg Brief, back with us, here's Yahara. Hey, Yahara.
Hi, John. President Trump has arrived in Japan for a series of meetings, telling reporters he's excited to meet with new Japanese Prime Minister Sanae Takaichi. The president will meet with Japanese Emperor Naruhito today ahead of the Prime Minister on Tuesday. He will also hold a dinner with corporate leaders on Tuesday night. Meanwhile, the U.S. government shutdown is now in its 27th day. NBC is reporting the country's largest union representing federal workers is urging Democrats to drop their demand to extend health care subsidies and join Republicans in supporting a stopgap resolution. And in sports, the World Series is tied at one game apiece. The Blue Jays dominated Game 1, winning 11-4 with a huge 9-run sixth inning. Dodgers bounced back in Game 2, winning 5-1 behind a dominant complete game performance from pitcher Yoshinobu Yamamoto. Game 3 is tonight in LA. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks very much. Up next on the program, the Fed under pressure.
I think they're under pressure to cut, and I think they will tend to do that. They have to be pretty careful about how much they signal more cuts going forward.
Greg Peters of PGIM up next, live from New York City. You're watching Bloomberg TV. The message coming from the administration over the weekend pretty clear. I think we have a really good chance of making a very comprehensive deal. The market gets it. It rallies hard, up by 0.8% on the S&P 500. Message received, up by 1.2% on the Nasdaq 100. That meeting between Xi and Trump taking place this coming Thursday. The day before that, this right here. Under surveillance this morning, the Fed under pressure.
Our main issues going forward as far as inflation goes is the pressure on the Fed and the ability of Congress to find some kind of compromise around the fiscal challenges that are building. I think they're under pressure to cut, and I think they will tend to do that. They have to be pretty careful about how much they signal more cuts going forward.
So here's the latest this morning. Optimism over a US-China trade deal pushing bond yields higher. The move comes as investors price in another rate cut later this week. Greg Peters of PGIM Fixed Income writing the following. Near-term dynamics remain challenging, policy sensitive and under fiscal stress, which may add pressure on rates. Greg joins us now for more. Greg, welcome back. Do you think supply issues might reassert themselves as a problem in the coming months?
I don't think supply is so much a problem in the coming months, but I think next year is a very different supply story. But I think the bigger issue is, you saw it in the CPI release, is that you are seeing inflation pressures away from rents and OER, right? And I expect that to continue into next year. And what I really worry about is that investors are very much of the mind the Fed's going to continue to cut. Inflation is, a 2021 story, largely contended with, and I think the risk is you're cutting into a higher growth, higher inflation environment, and the question is, what does the bond market think about that ultimately?
So, Greg, your point's interesting because this market took comfort from what was happening with shelter, but you're taking anxiety from what happens everywhere else. Greg, do you think the market's going to come around to your point of view, and why?
Well, so I think the shelter component, what has been an incredible disinflationary driver this year, and that's actually given kind of the broad CPI or disinflation numbers cover, right? But as we go into next year, you'll have continued pressure around those goods, particularly those, affected by tariffs. And, this is a story that's leaking out over time. This is not a one-shot type of idea. And so next year you have shelter either flattening out or even maybe moving higher. And that just changes the game, I think. And I think that is underappreciated.
Right now, I'm looking at break-even rates that are at the lowest levels going back to earlier this year. I'm looking at inflation expectations over the longer term. It's just falling significantly over the past couple of months. Why do you think that is? I mean, why do you think the market so profoundly disagrees with this higher inflation, higher growth view, at least based on market measurements?
I don't know. That is something that really confounds me, honestly. When I think about, next year, that is the most central figure that I look at. So what has a twofold effect. Number one, obviously, it's the market's measure around longer term inflation, but also, there's lots of talk around the Fed, what happens with the Lisa Cook case, what happens with the new Fed chair, what happens to the kind of the path of rates? Are we really moving to this really easy type of environment? And if the market starts to get spooked around that, that's going to manifest itself not only in the US dollar, but in five-year break even. So I look at that and I do scratch my head. And for my money, that is something that I'm kind of looking the other way. What I think it should be higher, not lower.
How much are you actually betting against some of these longer dated bonds? I mean, right now we're looking at a corporate sector that's in pretty good shape. You can make the argument that you should get tighter spreads. And at the same time, when you look at the government bond market, there's this sort of mystery wrapped in an enigma about inflation and why it's not being priced in more. How actively, aggressively are you betting against where things are now?
Well, what makes it incredibly tricky is just the uncertainty component around not only tariffs, right? We have a Supreme Court case that's coming due. What happens, after that? Well, and then there's lots of worries, I guess, around changes in issuance, changes in buybacks, and so investors are a little leery to lean too much into the curve steepener and the back end of the curve in particular, just because you can see that change in dynamics that could kind of catch investors by surprise. So I think there's a tentative nature around it. So I see it more cleanly, from 2s, 10s in that part of the curve. As you go further out, you're more exposed to these certain vagaries.
Greg, that's the Treasury market, and we've touched on the supply there. We'll get tons this week. Let's talk about the corporate supply that's coming this week as well, and what it's financing. Greg, is this market still wide open for this kind of debt issuance to finance the capex stories that we've been talking about in the media every single day?
It is for now. So there's just a tremendous amount. I start to scratch my head, as you go out the curve, particularly on the unsecured side. So there's been some deals in the marketplace that really don't make a lot of sense to me necessarily, but this is a tremendous build out. There's a tremendous amount of circularity around it. So this is, something that I think makes sense today. But as we go through this cycle, I worry about the refinancing aspect, and ultimately the AI, adoption and the return on investment that these companies need in order to make sense. And that's what starts to worry me. But as of right now, Jonathan, the markets are open. Everyone's all in on the AI trade, both sides of the debt and equity aisle. But at some point, there has to be a return on that invested capital. We shall see.
Well, Greg, with that in mind, how closely does someone like you watch the earnings as they come in on Wednesday, on Thursday?
Yeah, so I think earnings are incredibly important here. We have these long-term structural issues that we worry about, but honestly, from an investor standpoint, right, you worry about the cash flows and the earnings in the here and now. So I think it's crucial to kind of keep this market afloat. As long as you see, a pretty reasonably strong corporate environment and backdrop, I don't really see this bull market changing, anytime soon. So it's about the near-term data that's allowing investors to kind of look past maybe some of the longer-term structural issues that we talked about, namely Fed independence and, some other areas.
Greg, appreciate it. Thank you, sir. Greg Peters there of PGIM. Looking ahead to those earnings coming Wednesday, Thursday, more than $10 trillion of market cap on Wednesday. Same again on Thursday, just tons and tons of tech earnings. We've talked about potential constraints around the AI story. The conversation naturally drifts towards energy. Greg's already talking about whether this market's going to close up at some point and push back.
Yeah, right now it's not. And right now it's wide open and people are buying the $38 billion in Oracle debt. You've seen tech companies issue more debt now that is outstanding than even the financial sector, which is pretty notable. You start to wonder at what point people start to get skittish around what potentially they could get in terms of efficiencies and monetization of some of this. The fact that credit investors are watching earnings and that you could get bad earnings that torpedo the stock market and the credit market at the same time highlight how systemically risky some of these companies have become, albeit very solid in their balance sheets.
The credit market, Bramo, is saying do more, green light, lever up a little bit. You don't need a credit rating that high. Do some more.
They're saying, we want to be part of the trend too. Can you give us something to work with too? And they're saying, sure, here you go. Here are some bonds. So right now they're saying this is the way to go. And frankly, there's no sense right now that it's not coming to fruition in the balance sheets of these companies. We shall see. It's the big test this week.
A lot of supply coming this week. Up next on the programme, Abby Yoder of JP Morgan Private Bank, Angelo Zeno of CFRA to talk about those tech earnings, Pooja Sriram of Barclays, Noel Dixon of State Street. The third hour of Bloomberg Surveillance is just around the corner.
Earnings season has become front and center, and earnings have been strong.
People are investing more seriously than ever before, at least in the U.S.
This market has continued to rally and probably draws more and more people off the sidelines.
This is a very good economy for equities.
The underlying thesis on consumers and business spend is positive.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs on Friday. Same again this Monday morning. Up across the board on the S&P 500, higher by 0.8. On the Nasdaq, up by 1.2. With stocks up, bonds are down, yields are higher across the curve. 2s, 10s, 30s. Bond yields up by 2 basis points on 10s, just north of 4%. Going into this, been waiting for this week for quite a while. The busiest week for earnings season so far. This is it. Coming up on Wednesday and Thursday, a Federal Reserve rate decision. And these talks that are really fueling this market this morning between the US and China.
It's sort of like all the uncertainty could potentially be taken off the table this week. You could, not all of it, I mean, not to exaggerate, but you take a look at the idea that you could get some resolution between the US and China. You could get $27 trillion of market capitalization in companies that are reporting earnings that have been the backbone of this rally so far this year. And you could get a Fed that does just sort of seal the deal, 25 basis point rate cut this week, and then again signaling one more at the end of the year. You have your certain backdrop, the system's all a go, and that's why risk is rallying.
Dangerous talk, but year-end type feelings going into this week, just a little bit?
Yeah, definitely, especially when it comes to the trade talks, because we already know that they're being deferred until next year, at least when it comes to rare earths, which for China is their biggest piece of leverage they have going into these talks. They basically said that the 100% tariff that the president had is being taken off the table, and there's going to be some soybean purchases. So then we just have to start thinking about where is this relationship going in the next iteration of these talks, because right now it's basically going back to status quo, a truce.
2025 is over after Thursday.
This is what,
No?
okay.
No?
What is this? Let's get
the
you
government
to year
shutdown
end.
is
That's
not.
what I mean. That's what you're going to start the show on a Monday. Let's get you to year end, because that's sort of where your mind is at. And honestly, maybe, but there's still a lot
Isn't there?
more.
It's been like the longest
Year
10
ever.
months, 11 months ever.
100%.
We have to wait till NVIDIA on November 19th. Then it's year end.
I feel like it's year over already. Maybe it's not.
Make it happen.
It should be. Equity futures on the S&P up by 0.8%. Coming up this hour, Abby Yoder of JP Morgan Private Bank. As stocks trade near all-time highs, Angelo Zeno of CFRA previewing big tech earnings on deck this week. Plus, Pooja Sriram of Barclays with a key Fed rate decision just around the corner. We begin this hour with stocks soaring as investors gear up for a crucial week on Wall Street. Abby Yoder of JP Morgan Private Bank writing, we believe that the valuation of the S&P can remain elevated given technology's growing dominance in the index and strong profitability. Abby joins us now for more. Abby, good morning.
Good morning.
How dependable is the earnings story at the moment?
I mean, it feels pretty dependable. I think expectations have definitely crept higher as we get to this very big week of earnings. And, you know, it hasn't always been like straight up into the right in terms of whether or not we hear from these hyperscalers and they increase their CapEx expectations. Like last quarter, yes, there was positive, price action. But because you're seeing that, their CapEx is creeping up as a percent of their operating cash flow, like there's going to be a lot of focus on, okay, what is the ROI on this? And the interesting and good thing is that you are seeing that trended up into the right as well, right? Like that is moving higher, as I think investors would like that to be a little bit quicker. And I do feel like we're kind of at this inflection point in terms of seeing that move higher.
And that's going to be a big story for Meta later this week to get stock specific, to talk about sectors, what you like, tech, financials, utilities. Is that all the same trade?
I would say financials are a little bit different, right? Because they're going to be more cyclical in nature, the way that we're thinking about them. You've got a lot of things happening that are good for them in terms of you've got the yield curve steepening, which is good for net interest income. Credit was really benign. I know there were pockets of a little bit of concern on the lower end over the past couple of weeks, but when you think about the GSIBs, they tend to be higher quality in nature and don't have as much of that exposure. And we saw that in earnings for the most part. And then you think about like what's happening from a deregulatory standpoint, right? Like there were some rumors last week about about Basel III coming out being in mid-single digit capital requirements versus the 19% for the large caps that was floated last year. So that's very important in terms of that trade.
Yeah, but to build on what John is talking about, the idea that utilities are being bolstered and aren't exactly the safety trade because they are going to benefit significantly from the tech trade. And the tech trade has fueled everything else, including credit markets increasingly as the issuance of debt related to these companies increases. At what point is this the catalyst, the risk event, frankly, for the second half of the year? The idea that the earnings have to show some proof in not only the capital expenditures, but monetization.
Well, I would also say, like, if you're thinking about utilities, to your point, being more of an AI trade now, like, they're not the ones that are spending all of this CapEx that you're waiting to see that ROI. Like, energy is the bottleneck. They're signing these agreements with these hyperscalers, so they're the beneficiaries of that, right? Like, you're seeing those cash flows already happen for them. Like, obviously they need to build out these, the capability. But if you're thinking about the risk, where if you're looking at the hyperscalers, it's like, okay, where's the ROI on your CapEx that continues to increase at these eye-popping numbers? Utilities are kind of the other side of that trade, right? They're the benefactors of that cash flow. So to your point, like, thinking about where you're seeing, the increase in earnings, it's really on the utility side at the moment too.
What do you have to see in the Magnificent Seven earnings that could make you believe in the broadening out trade, that other companies are actually going to get some efficiencies from the use of some of the new technology?
Well, I mean, I don't know if it's necessarily from them as much as it's going to be from the other companies that are talking about it, right? Because you have seen that. I think the most interesting sector to really look at in terms of who's utilizing, how can you think about it broadening out, is going to be industrials, right? They're at the kind of like epicenter of all of these different long-term structural trends in the form of reindustrialization. And we're all thinking about trying to be more efficient in what is like a less efficient supply chain world, right? Like, when you think about the past 25 years, it's all about efficiency. It's just-in-time inventories. We're moving away from that in the sense that we're trying to be, very strategic from a supply chain standpoint. So how are you using AI to kind of expedite and make those processes that would have been otherwise redundant more efficient going forward? So I think that's a really interesting thing.
Going back to how John started this hour, though, the fact that it does feel like we're almost going into year end. Do you feel like a lot of uncertainty has been evaporated out of Washington, especially this week when it comes to our biggest trading partner?
I was shaking my head the whole time you were talking about that. It does feel like it's already December, notwithstanding that it's very cold. But I mean, I think it's interesting that we are kind of operating in a data vacuum from a government standpoint, and it doesn't really seem to matter. I mean, we've got CPI, which is obviously very important. I think, look, you can look at 2 weeks ago or 3 weeks ago when we got the trade headline around, rare earths and this, re-upping the tariffs around China, and the market was down, right? Like, it was down, NASDAQ was down over 3% that day. Like, there is an element of, okay, well, that's an embargo from an economic standpoint. That's hitting the AI trade. There's a concern there. So, like, it feels like we're getting to the point in the negotiations where it's going to really matter for markets, and particularly on the tech side, because that seems to be where the negotiations are going between these two countries. But I do think it matters. I don't think it's like completely ignoring it, but I do think at the end of the day, the market was guessing and betting that this outcome that we have was going to happen, right? That it was going to either be delayed or there was going to be progress made, and it wasn't going to actually be that headline number that we got that Friday.
I'm not going to say it's year over, just for the record.
Okay.
Because bad things can happen. There's enough time.
The year is ending, though. The year is almost
I mean, by definition, it's ending.
Good things can also happen.
It's been ending since June.
Good things can happen too. Thanks for that, Abby. Thank you very much. Got a few more months left. Let's hope some good things happen as well. What are we taking for granted? I often think about that because it feels like rate cuts are the things we're taking for granted right now. And if I look at all the research at the moment beyond this meeting, I'm not sure how you guide into year end. Things can change in May, and that feels like a separate story to me when we get a change of leadership. But between now and May, are we taking some rate cuts for granted here?
Well, so we actually are expecting less rate cuts than I would say the market is. We have 3 through the end of next year, because it does, to your point, everything we're talking about, it's like not only do you have the economy on really solid footing, earnings on really solid footing, we're heading into 2026 where you have, this growth impulse from the reconciliation bill, both on the consumer and corporate side, where it's like, how do you not see a reacceleration in growth? Now, the way that you avoid, this difficult situation for the Fed is that you see also a commensurate increase in productivity, so therefore inflation isn't as much of an issue. But now that we're in this vacuum in terms of the labor market, I mean, it's a big question as what the Fed guides to, right? Like, it's super, super tricky. We're not envious of them at all. But I think, just thinking about where we're seeing rates going from here, we have far less cuts than the market is pricing.
So just give me an idea of what it looks like, what you're expecting versus what's priced right now.
So we have 3 cuts through the end of next year versus, I think, 5.
Through the end of next year?
Yeah.
From now? Just 3? Okay, interesting. Abby, if you're right and this market's wrong, what's mispriced? Fixed income?
Yes.
Yeah?
Okay.
Exactly. Abby, thank you.
Yeah.
I'd like to think about that. That's like the punchline. All
Okay.
right. Abby Yoder of JP Morgan Private Bank, thank you very much. Can you imagine that? Just 3 from here.
Yeah, well, it really raises the question, how much is this market leveraged to the idea of aggressive rate cuts, even regardless of what the economic data is, even if we do continue to get strength? And that's a real key question. How much is the debt market in particular? Is it the credit or is it the government debt market mispriced to that? And I think that that's what clearly Greg Peters is wrestling with, given the fact that it seems like a conundrum to have such robust growth, sticky inflation, and a Fed that's going to be aggressively cutting.
If that's the case, then someone that the president puts as the new Fed chair will not be delivering on what he wants to see.
At the moment, the market's getting the best of both worlds. Gets the earnings from big tech, which makes up a major chunk of the S&P 500. The Federal Reserve's freaking out about something the market doesn't really care about, downshifting payroll, so they get the rate cuts too. It's like the best of both worlds at the moment, and I wonder how much longer that can persist.
I guess that the real conundrum has been that 10-year yields have been so behaved. So, yes, it has been the best of both worlds, but the market's not freaking out about inflation either. And next year, it is going to be difficult for any Fed chair that President Trump appoints to continue with rate cuts if you do have it on more 10-year yield. And that is going to be sort of the fly in the ointment. And that's the reason why people are watching this and saying that Fed chair is going to have to ultimately be constrained by the market.
It's certainly difficult to get the committee to come with them. Anyway, you mentioned the bond market, 10s at the moment. Lisa's right, around 4%. No freak out here. Yields high by just a single basis point. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Trump has arrived in Japan for a series of meetings, telling reporters he's excited to meet with new Japanese Prime Minister Sanae Takaichi. The president will meet with Japanese Emperor Naruhito today. Ahead of the Prime Minister on Tuesday, he will also hold a dinner with corporate leaders on Tuesday night. Meanwhile, Hurricane Melissa became the Atlantic season's third Category 5 storm in the Caribbean this year. The storm is expected to make landfall in Jamaica early tomorrow. More than 800 shelters have been opened across the island with warnings of unprecedented damage to facilities and infrastructure. And more than 100,000 New Yorkers turned out this weekend to pick the next mayor of New York City. The frontrunner Democratic Socialist Zohran Mamdani is running on free buses and freezing rent-stabilized apartments. With only 8 days until Election Day, supporters of Andrew Cuomo are pouring money into a ground game, while Republican Curtis Sliwa trails in third place. That's Bloomberg Brief. John?
Yahara, thank you. Up next, the morning calls. Plus, we'll catch up with Angelo Zeno of CFRA as we look ahead to a big week for big tech from New York City. Good morning.
The number one question from clients is, are we in an AI bubble? I'm in every single meeting. So maybe that convinces me that we're not in an AI bubble, but I think that's going to be the key catalyst this week. I mean, the earnings season so far has been amazing, right? 87% of beats. We're running at 10% growth year on year. I think if the Mag 7 can continue to deliver, that continues to drive a lot of upside.
Big Tech in focus this week. Massive earnings reports coming on Wednesday and on Thursday. That was Alistair Pinder of HSBC into that all-time highs on the equity market, up 0.8% on the S&P, on the Nasdaq 100 up by 1.3. That's the price action. Let's get you some morning calls. First up, UBS raising its price target on ARM to 200, highlighting easing tariff concerns. Your second call from Goldman, upgrading Victoria's Secret to neutral, expecting sustained improvement in brand momentum. And finally, Guggenheim upgrading Microsoft to buy, emphasizing its ability to directly monetize AI offerings. That stock is higher in early trading, up by 1.41%. Let's stick with tech. A slew of mega cap tech earnings reporting this week. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, of those names, Microsoft, Alphabet, Meta, Apple, Amazon, what's the number one focus for you?
I mean, it has to be the cloud growth for Microsoft, Google, and Amazon. And look, it's no different from the last time around, but what changed with the print last quarter was Microsoft got close to 40% in Azure growth. It'll be interesting to see if they actually surpass that higher bogey. And to my mind, that's the justification for increase in CapEx, because the expectations for 2026 are still somewhat lower than what we saw this year, which was almost, close to 60% growth. Next year, it's more low teens or low to mid teens. And so to my mind, all these companies will raise their CapEx, and that will be dictated by whether they beat on that cloud number or not.
Mandeep, as you know, all these names get thrown into the same bucket. I'll throw another name out there, Meta. Is the market more comfortable with the spending of some companies at the moment versus others? You mentioned Microsoft. I just wonder who the market is less comfortable with at the moment.
I think I would put Meta in that bucket because they don't have a cloud business. And look, they will see benefit from AI in their ad pricing, the recommendation systems. But in the end, if you're not showing a separate, AI number right now in your print, then the market will question what is AI versus what is non-AI. And in the case of Meta, if they are looking to raise their capex close to 100 billion, which is what our number is for all these hyperscalers, Microsoft, Google, Amazon, then you have to ask yourself, what is the ROI? And that ROI question, I think, is extremely relevant for someone like Meta if they are going to raise their capex.
Mandeep, you're in Hong Kong. One thing we've highlighted over the last few weeks is just how different the approach seems to be in Asia. Efficiency. In America, it feels like they're rushing to spend because they're confronting an existential crisis. Mandeep, do you pick up the same tone, the same theme whilst you're over there?
I do, and everyone is asking me about, what kind of optimizations the cloud providers plan to do. How will that trickle down in terms of their appetite for NVIDIA GPUs in 2026? And really, when you come to, this part of the region, DeepSeek and the Chinese models, they have an open source approach. So that is a big focus in terms of what the frontier LLMs plan to do in the US and elsewhere, whether they want to embrace open source or not. And that, I think, is an open question at this point of time.
Mandeep Singh of Bloomberg Intelligence. Mandeep, thank you, sir. Let's continue the conversation. Looking ahead to big tech earnings, Angelo Zeno of CFRA is remaining bullish. He writes this: we anticipate a still healthy cloud and digital ad environment as greater AI integration and rising enterprise adoption will continue to support upside. Angelo joins us now for more. Angelo, welcome. You heard Mandeep a little bit more cautious on the likes of, say, Meta. Do you share that caution?
We do. Actually, we would view Meta as probably the biggest risk among the mega cap names that are reporting this week. And really kind of just, I would just echo some of the comments that were just made in the sense that we do think that you look at the CapEx, the capital intensity numbers among these hyperscalers or big tech names, and Meta not having its own cloud business, given the fact that, listen, it is more of a cost center when you think about the AI investments that they are making, despite the fact that, listen, they are monetizing it to an extent in terms of improving the recommendations and content across the platform. That being said, they are not monetizing it to the level that these cloud providers are. So as a result, I mean, there is more risk tied to them as these depreciation costs start to really kind of gain traction here over the next couple of years. And when you actually look at the magnitude of the spend that we already know Meta is going to do, or what they've alluded to for 2026, at about 100 billion next year relative to 70 billion this year, and let's call it 40 billion just a year ago. That is a tremendous increase for any company out there, but especially Meta, given the fact that they can't monetize it to the level that these cloud providers are.
Angela, I feel like we have this conversation every time before Meta reports earnings. They can't keep it up. Yeah. What are they actually making money on? And then they come out with earnings and their stock shoots up at 10%. I mean, What can we potentially see in terms of going forward with the team that they have amassed with huge bonuses that could potentially buck the trend or make you think that they could have significant upside?
And that's a great question. I mean, when you look at these mega cap names, Meta's actually growing the fastest. So from that perspective, I mean, you have to give them credit. I mean, they're going to grow the top line this quarter north of 20%, which is going to be faster than any of these, than the Microsofts and the Alphabets of the world. So from that perspective, hey, listen, the fact that they can continue to grow the top line and in many respects actually manage the margins in a very healthy manner, at least up until now, they've continued to demonstrate very good success, and the stock prices continues to go higher, which is why we're still recommending the stock and have a buy recommendation on it. But when you kind of look ahead here, and you look at the talent that they've really amassed here, the potential to expand the addressable market, whether it be in terms of the devices side, which probably has a longer tail, or whether it be in terms of finding new innovative ways to really monetize their ad-based platforms, whether it be with Meta AI, having more of these kind of in-app these ad interactions. They know more about us than any other company out there when you start thinking about it. So they can definitely monetize that platform in many new and innovative ways that they haven't done so yet. And mind you, they do still have Threads, which they're really not monetizing at this point in time. That installed base continues to grow pretty fast. And it is going to be, we think, more of a monetizable story in 2026 and 2027. So they do have that going for them.
There's a real question around monetization for the likes of Meta, Microsoft, and Alphabet when it comes to the AI story. There's also a question of the energy constraint and how much they are increasingly tied to that story as a potential hindrance to some of their expansion plans. Are you expecting to hear anything about that in these earnings? We've talked a lot about some of the big deals that they've come out with private equity firms and with a lot of banks in terms of trying to build out their own energy centers as they try to meet this demand.
I mean, I think the questions, will be brought up. I don't know if there's anything that they're directly going to, address from that perspective. I think they'll just allude to some of the facts that you just mentioned. And at this point in time, listen, this is one of those situations where they continue to, or I'd say is probably the biggest potential bottleneck for the industry. But that said, I mean, listen, they continue to aggressively invest, whether it be, in terms of energy needs, whether it, be just in the overall data center buildouts, and of course, installing these servers. So, it's going to come at a hefty cost, but one way or another, if the demand is there, they're going to find a way, we think, to make sure that that demand is realized.
Angelo, on all of these names, whether or not it's Google, Apple, Meta, Microsoft, going into earnings, you have either a buy or a strong buy. Who's most vulnerable on your list?
As far as this earnings season is concerned, most vulnerable, it's, we've kind of highlighted Meta, which we would say is probably the biggest risk here over the next couple of quarters, just because of the uncertainties there. And not to mention the digital ad side is typically more at risk to, uncertainties on the macro side than any other factors out there. I would say, when you go into this earnings season, I think there's been a lot of hype going into Apple. Again, it's a name we like, and we think it's going to be a great story into 2026. But I think the street at this point in time, essentially, whether or not is right, they're essentially looking for double-digit growth, I think, on the hardware side of things here for the September quarter and December quarter. So it'll be interesting to see whether or not they can meet that high bar. Also, as far as the AI story is concerned, we do think they get that right. It's going to be more of a 2026 story. I don't think it's anything that you really hear too much about this earnings season. So I think there might be a little bit too much hype going into Apple, going into the print. But that said, I mean, any type of pullback we think on the name should be, and we think will be bought back pretty quickly.
Angela, I've got 30 seconds, so keep this brief if you can. Do you think Meta is on the brink of a third quarter 2022 type moment all over again? Or are we beyond that now?
I mean, that's a great question. I think we're beyond that. But, I think it remains to be seen. I think, I really think Meta is this really interesting story. I mean, and the cost that they've been able to absorb in many respects and still grow and keep those margins, I think is really interesting. I think there's also, the potential for them to really cut some other non-AI oriented costs, whether it be tied to the metaverse or something else, that could really, help them here over the next couple of quarters. So we'll see.
Could be a stock to watch. Angelo, appreciate your honesty. Thank you, sir. Angelo Zeno there of CFRA. Up next, Pooja Sriram of Barclays. That rate decision a few days away. The opening about 60 minutes away. Two-day winning streak on the S&P 500. 2 consecutive weeks of gains. Last week, the biggest weekly gain for the benchmark in America going back to August. A boost to this equity market and another boost this morning, up by 1.3 on the Nasdaq 100. Outperformance on the Russell last week. This morning, up by another 1%. As we count you down to the cash open, let's get you some morning movers with Danny. Hey, Danny.
Hey, John. A scoop from the deals team this morning that Nelson Peltz's Trion is looking at buying the rest of Janus Henderson that it does not already own. It's teaming up with General Catalyst to do this. Trion already owns about 20%. So, again, this would just be for the remaining share. Shares are up just under 13% for Janus Henderson. Elsewhere, it is the big hyperscaler earnings this week. Microsoft will be reporting on Wednesday, and we had an analyst upgrade heading into that from Guggenheim saying that they are well positioned to take advantage of the AI trade. But this is a significant upgrade because now 99% of analysts have a buy rating on Microsoft. So those shares up 1.4% off the back of that. We also learned from Lululemon this morning that they will now be selling NFL apparel. They're teaming up with Fanatics and NFL to do that. Shares are up 4% off the back of that. Lululemon has been leaning more into athletics, signing on various sports stars like Lewis Hamilton for this advertisement campaign. Apparently, Joe Montana is going to be the face of that. So interested to see what Lululemon gear he wears. John.
They've got to turn this story around because they've had a terrible year. That stock has had a terrible year. Then he mentioned Microsoft. Just looking at the analyst recommendations, you're doing the same thing. 72 buys, 1 hold, 0 sales.
Why fight against a train that has been a freight train, that has been such an engine of growth and that is backing the entire equity market? You could argue there have been studies that show that buy-side analysts tend to be overweight and bullish on stocks until the very end. So you could make that argument that it's not exactly a leading indicator. Nonetheless, how much career risk? This is sort of what I hear in my head, your voice saying, how much career risk must there be to say, sell your Microsoft holdings right now?
Yeah. Losing access to management, all of those kind of things.
Losing access to your investors.
Plagues the industry.
Yeah, well, that's true, too.
It's a problem. It's a real problem. Equity futures on the S&P up by 0.8% so far this morning. Looking ahead to the week ahead, lots of tech earnings coming Wednesday and Thursday. Big meeting between the US and Chinese leader coming up on Thursday too. Sandwiched in between somewhere, a Federal Reserve decision that we're all taking for granted. Mike McKee, just an assumption, they cut interest rates again. And it's easy sailing, except you and I both know it's different. That committee, Mike, how difficult will it be for the Chairman Powell to communicate anything beyond the October decision?
Oh, it's going to be very difficult because the government shutdown has lasted so long now. We're really in danger of losing the data we would have gotten for October, and who knows what's going to happen in November. They don't meet after a Wednesday until the 10th of December. But I do have a surprise for you this morning, something they can hang their hat on a little bit. We have some data. The Chicago Fed puts together a real-time unemployment forecast. They do use some of the government data in it, but since they haven't got it, they're estimating. And they say in October we would have had an unemployment rate of 4.35%. September would have been 4.34%, so no real difference. They'll update this on November 6th, which is the day before we would get the the payroll numbers for October if they were coming out. But their view is we're not seeing a real deterioration in the labor market. You do mention that Wednesday is the Fed meeting. We have a very light data week because all these data points have been canceled. So you can pretty much focus, except for Wednesday, on all the tech earnings. We do get consumer confidence. And jobless claims, we get now the raw data, 4 o'clock on Thursday afternoons. We adjusted for you. By Friday morning, we'll have a pretty good idea of what jobless claims are. And as we saw last week, they're not really changing the picture either. And here's one bit of good news, maybe. Omer Sharif, he's at Inflation Insights. He's looked at the possibility of an October CPI report if the shutdown ends within the first week of November. He says that BLS suggests they need only about 2.5% of their sample to get a reasonable estimate for the CPI. They'll have gasoline, cars, wireless phones data already sent in by the private sector, some for apparel, furnishings, and prescription drugs. And they can go call up landlords, the big landlords, and ask them, what were you charging? Same with insurance. So he thinks there's a possibility, you can keep your fingers crossed, that the Fed will have some sort of price data to use before the next meeting. Mike,
just remind us, when's the survey week for payrolls? When do things get messy if we miss that?
Survey week is the week that the week that includes the payroll that would be on the 12th of the month. So we have well past that, but a lot of that data, almost all of it comes in now from electronic sources. So we can get the total number of jobs once there's somebody to put that out. It's the unemployment number that's difficult to get because that's a telephone survey. And the longer you go without doing it, the more you get into memory bias and things like that. So there's a possibility we get half of that report.
And Mike, I'd given up on October. I was thinking about November. Mike, thank you. Mike McKee there. Yeah, I think we've all given up on October, haven't we?
I mean, honestly, how difficult the situation is that we are completely blind. And we are going to be completely blind for at least 1 month, if not 2, if not 3. You are right. How likely is it that we're going to get data in any kind of clean sense through the end of the year? So year over, like you said.
Confirmation bias. It's difficult to get people to change their priors when we don't have the data. And that's why the divisions of the Federal Reserve aren't going to resolve themselves anytime soon.
It's equally difficult because people are looking at earnings to try to fill the gap. And we keep saying the market is not the economy. These big companies are not necessarily the Main Street classic struggle that you're seeing in some of the private asset markets, which have seen pockets of weakness, not necessarily systemic, but pockets. I mean, that to me is really the key question. How much are people flying blind and going with just confirmation bias?
I'm joking about year over, just a little bit, of course.
Are you?
But no September jobs report, no October jobs report. It looks like, based on what you're telling us about what's going on down in Washington, D.C., Terry Haynes was on the programme earlier this morning, and he said end of November is when the shutdown ends. So maybe no November jobs report either. So we're waiting for how much longer before we get this data?
I mean, weeks, if not months, definitely, when it comes to the data. Weeks, if not months. But Mike McKee's point there, someone talking about the fact that we can maybe get somewhat of a print just based off a 2.5% sample, that maybe speaks to maybe we need to have better data collection.
It's going to raise obvious questions. Omar does fantastic work, by the way, on the inflation story. Let's stick with the Federal Reserve ahead of Wednesday's rate decision. Pooja Sriram of Barclays writing, the FOMC is nearly certain to cut 25 basis points this week. Pending surprises, we retain our baseline for additional cuts in December, March and June, with risk that these cuts are more delayed. Pooja joins us now for more. Pooja, good morning.
Good morning.
Let's pick up on that. So October feels like it's done. I can't find a single person who thinks they won't cut interest rates on Wednesday. We've been sort of pondering the idea that it gets difficult to guide beyond October. How does Chairman Powell navigate that in the news conference?
Yeah, it's going to be difficult. I mean, we are in uncharted territory when it comes to not having data flow. This is indeed the longest the BLS has had to furlough workers. And it's going to create a pretty messy situation in terms of not having decent October data, maybe not having October data at all. And I think at the minimum, he will communicate that, they've not had their traditional estimates from official data. And it's going to be difficult. But this is where it gets problematic, right? Data or no data, you still have to make policy. And that's where it gets tricky for the FOMC.
So they're in the risk management business. Why is the prudent decision to carry on cutting when you don't have the data you need?
Well, I think whatever we're getting in terms of alternative data on labor markets are still pretty decent relative to, I think, the alternative data we get on inflation, for example. And, we've been getting state-wise claims data that seem to suggest that claims have been about where they've been in the past couple of months and not really moving much higher, but also not at very low levels. We're able to piece together some data on job openings, some data in terms of hiring, and it gives us a situation where the labor market is very similar to how it was in August, which is pretty low level of monthly employment gains at about 30 to 40,000 a month. We have some indication, as Michael pointed out, from the Chicago Fed, which tells you the unemployment rate is at 4.3, perhaps ticking slightly up. So if anything, the data seems to paint a picture that risks to the employment side of their mandate are still very much to the downside. On the other hand, we did get that one exception, which is the September CPI data. And again, pretty benign despite all the tariff noise. So in that world, they could perhaps decide that cutting one more time in December seems to be the prudent policy decision to make.
Which is a de facto tacit admission that 3% inflation is fine. I mean, at a certain point, you have to think they don't seem bothered by 3% inflation, even though they still say that 2% is their target. You expect CPI to end the year at 3.1%, and the following year, 2026, at 2.8%. 3% essentially. I mean, is that really what you're seeing?
I think the story here is, again, you're looking at the employment side of the mandate and getting more concerned about that. The inflation story, I think, for the FOMC is one where it's really a lot of the tariff-induced price shock, but something that could subside potentially, over 2026. And that, I think, feeds into their narrative that inflation is perhaps on track towards their target, and the employment side really needs to be addressed. Risks, admittedly, Lisa, are to the upside for inflation.
There's also a question about whether people are underappreciating strength in the labor market going forward. And maybe not now, but maybe beginning of next year, if people do have more confidence and companies are getting a stronger sense of what the backdrop is, they're getting some of the rebates from tax plans. What's to say that there isn't an upside risk to hiring, given the fact that a lot of companies have been sitting on their hands but doing pretty well?
I think that's a fair statement. And it's, again, you've got to wait and watch. to see how this pans out. We are now in a very precarious balance between labor supply and labor demand, right? Something that Chair Powell has told us. We've never in the past seen this really odd dynamic where we're seeing labor demand weaken, but at the same time, you're getting this pretty sharp drawback in labor supply because of the immigration restrictions. And while theoretically it seems to make sense that it's really a labor supply story, you shouldn't see labor market slack pick up, etc. I think from a risk management perspective, that's what the FOMC is doing. We've got to wait and watch to see how the data pan out.
You mentioned tariff-induced inflation. Where are you seeing the pass-through right now?
It's hard to say because it really depends on what the counterfactual would have been had we not had tariffs, right? Now, our estimate is the pass-through has been anywhere between 50 to 60% on average, and there is likely more to come. But again, this is something that's been extremely hard to estimate on a month-to-month basis. The closest historical precedent we've had is a 2018-19 trade scenario. And even then, I wouldn't say it's necessarily an apples-to-apples comparison. But we're seeing signs that there has been tariff-induced price pressures. And our sense is, as we enter Q4, perhaps early Q1, there's more to come.
If there's more to come, how do you get to the 2.8% inflation target of next year that Lisa was mentioning?
Well, I think it's really a concept of base effects. If you think you get really elevated inflation in Q4 of this year, but it really starts to wind down by the end of 2026, you could get that 2.8%. It's not ideal, as Lisa said, but perhaps not as high as 3 or the above 3% that we were once forecasting.
Pooja, it's good to see you. Thanks for being here. Looking ahead to this Fed decision later this week. Pooja Sriram there of Barclays. I'm pleased you brought up the forecast, Bramo. It's just been this rolling 3-year view of getting back to 2%. And we've been rolling with this 3-year view of getting back to 2% for a number of years now. And the tension, I think, is building between the aspirational forecast the Fed puts out every quarter and the reality of the data itself. And if you keep cutting with inflation closer to 3 than it is to 2, overwhelmingly the consensus is going to be that you don't really care about the 2% inflation target anymore. And there's good reason for that opinion.
It's been 5 years with inflation above 3%. According to Pooja Sriram and the folks over at Barclays, you're talking about next year being basically at 3%, 2.8%. So that would be 6 years of essentially 3% inflation. At a certain point, is that okay? Is that kind of what a market is just accepting and not necessarily freaking out about? And is the Fed taking that and running with it?
There was a scathing Wall Street Journal editorial board opinion piece this weekend that talked about also not just the Fed, but Washington in general, even the politicians accepting a de facto 3% inflation target and how they don't think this is what anyone had in mind when they cast their votes last year.
Credit to Alarian. Talked about this years ago. If you were to set today's inflation target, you wouldn't pick 2, you'd pick 3. It's hard to get it down to 2. And this Federal Reserve's not in a position right now to even think about that or comment on it publicly.
And frankly, they don't want to risk the labor market in order to make that compromise. And right now, they're going to keep saying 2%, but right now their actions are saying 3.
Stocks are at record highs. They like it, in the equity market at least. It's weird the bond market's so comfortable with this, but that's a conversation for another time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Javier Milei's party won Argentina's midterm vote. Milei said he'd have the backing of 101 members of the lower house and 20 senators, protecting his veto power. The result allows him to pursue free market policies with billions of dollars in backing from the Trump administration. Meanwhile, the U.S. and China are closing in on a trade deal. Both sides spent the weekend in Malaysia coming to terms on a range of issues, including export controls, fentanyl, and shipping fees. Treasury Secretary Scott Bessent says President Trump's threat of a 100% tariff on Chinese goods is effectively off the table, and he expects China will make substantial purchases of American soybeans. And the New York Jets finally earned their first win of the season yesterday, pulling off a thrilling comeback to beat the Bengals 39-38. The Giants were not so lucky, falling to the Eagles 38-20, while the Patriots dominated the Browns on their way to a 5th straight win. And in prime time, the Packers, led by Jordan Love, came back from a halftime deficit to defeat Aaron Rodgers and the Steelers 35-25. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, Noel Dixon of State Street's here with trade optimism pushing bond yields higher and equities a whole lot higher. Equity futures going into the opening bell up this morning by 0.8%.
What I really worry about is that investors are very much of the mind the Fed's going to continue to cut. Inflation is, a 2021 story, largely contended with. And I think the risk is you're cutting into a higher growth, higher inflation environment. And the question is, what does the bond market think about that ultimately?
In the meantime, who cares? Equity market loves it. Seems to be the takeaway. That's not my view. That's Craig Peters there of PGIM. Fixed income, all-time highs on the S&P 500. Could it disrupt fixed income in the months to come? At the moment, not really. Equity futures up by 0.8% on the S&P, on the Nasdaq 100 higher by 1.2. What a week we've got coming up for you. The week ahead looks like this. At 8:30 p.m. Eastern Time, the President holding a bilat with the Japanese Prime Minister. Then things really start to pick up into Wednesday. The Fed's interest rate decision and Chairman Powell news conference is just around the corner, plus earnings from Microsoft, Alphabet, Meta. Thursday, a sit-down meeting between Trump and Xi, plus numbers from Apple and Amazon, and throw in there too an ECB interest rate decision just for good measure. Equity markets are doing well, up by 0.8% into all of that. Noel Dixon of State Street writing the following: despite the impulse to decouple and the potential for further horse trading between the US and China, the mutual economic interdependence will likely yield a result that markets can live with. Noel joins us now for more. Noel, welcome. Equity market likes it. You've talked about the path of least resistance, higher. When do things start to get tricky?
Yeah, thanks for having me. I think things start to get tricky when we get into the first quarter of next year. I do think that, the Fed right now, they're probably easing into strength into the U.S. When we look at non-residential fixed investment, we see, a pickup year over year, pretty solid on the equipment side, not so much with structures. When we look at the labor market, it's interesting. Before the shutdown, the labor market actually was still at least on track, although moderating, on track to not have a spike in the unemployment rate. So we have on aggregate a consumer that I think is still in a pretty decent position. Like I said, CapEx spending is starting to look pretty healthy. So we do have a situation, I think, where the Fed is likely cutting into strength.
At this point, it seems like big tech has been the leadership. We've seen the Magnificent Seven names account for about half of the 15% gain that we've seen in the S&P 500 year to date. How important is it to see really good earnings, better than good, better expectations than anyone could have imagined in order to keep it going?
Yeah, I think the bar is high. And I think that, even if we get, say, a number that's in line and it doesn't really knock the cover off the ball, I do think the bottom line is there is no other alternative. I think, the Mag 7 still are appealing. Some of the other broader tech, hardware, software companies are still appealing. I think that's the path of least resistance, relative to the other 493 in the S&P. These tech companies have the solid earnings, and they have the trajectory of, basically this AI revolution.
Meanwhile, earlier this morning, we were talking to Avitas Perduto from RBC, and he was talking about bank mergers and how that's been a huge driver of activity outside of the tech sphere, although you could argue it is also levered somewhat to the tech sphere. This morning, we got another deal, Huntington Bank shares agreeing to buy Cadence Bank, and it just sort of goes to this idea that maybe even in the regional bank space, there's real alpha. Is that an area that you're looking at because of this huge wave of M&A?
Yeah, so the regional bank space, I think there is some opportunity, not necessarily due to, alpha generation more so. I just think there has to be a consolidation, as I think some of the, for example, delinquencies with office loans, that's crept up, if you look at the St. Louis Fed's measure, to about 11%. So that's the highest since the GFC. So I think there's a recognition that there has to be some consolidation to sort of remedy some of these dislocations, I think, that exist in the credit space.
Noel, Jonathan talked about your note coming into you about the mutual economic interdependence between Beijing and Washington that basically results in a deal that the markets can live with. What could the markets not live with? Because doesn't that act as a barometer to this administration? Yeah, absolutely. I think the markets cannot live with a
decoupling 100% additional tariffs on top of what's already implemented with China. They can't live with a China that basically cuts off rare earth exports. So if there is basically a tension or not a resolution to this trade sort of spat between the U.S. and China, that will be problematic for risk.
But does the market care that this is basically deferred until next year?
No, it doesn't. I think it's basically, all we need to do is have something surface level that basically alleviates sort of the tail risks, like as I just mentioned previous to this, that eliminates those sort of rare earth dislocations, anything to do with export controls, any of those surface level issues. If we could get those reconciled, that'll be good enough for markets.
No, thank you, sir. Always appreciate catching up with you. Noel Dixon there of State Street Global Markets on the three big issues we're facing this week. Earnings on the tech side, Federal Reserve's decision on Wednesday, big talks between the Chinese and US leader. Market's comfortable with where things are. It's remarkable the market's comfortable with the status quo regarding trade, but seems to be. So long as we avoid escalation, I feel like that's good enough. And the news we got over the weekend, I think, went beyond just avoiding escalation.
It really went to coming up with more of a framework, and I don't think people were expecting a real comprehensive framework ahead of that meeting between Xi Jinping and Donald Trump, and I think that really is the key. There was progress made, and how much was it because of the strategic misstep that China made with rare earths and what ire it created around the world?
At the same time, it does feel like a Band-Aid to what's going to be in 2026 when China might decide to pull out the rare earth export controls once again, which is why it feels like we're back to where the relationship was in May at the Geneva talks.
Just takes the bar up just a little bit going into that meeting. Greater scope for disappointment now, given the read-through over the weekend.
Yeah, but right now, keeping the status quo is good because that gives time. And both sides are buying time because they want to rearrange. But you're right. If suddenly someone says something bad and there's an advertisement or there's a Winnie the Pooh image or something like that, everything goes
Why
haywire.
Winnie the Pooh?
I'm
not making you go there, don't worry. I'm not doing that. I know exactly what you meant.
Right?
I know exactly
really?
what you meant. All right. Yeah.
Okay, let's move on.
Coming up tomorrow, Jack Caffrey of JP Morgan, Congressman French Hill, former Dallas Fed President Robert Kaplan, Ed Yardeni of Yardeni Research. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.